roughly back in line with where we were in 2017, still difficulty filling positions as well. And so small businesses are still out there looking to hire, but it remains a difficult jobs market for them.
So do you still have concerns about the last mile, or do you think that the pace that some of the weakening is happening is enough to get us back down to 2% without the Fed doing that much more?
So I think we have seen some pretty marked progress on the inflation front, and I think the 2% inflation is a little bit closer than I might have imagined, 6 months or so ago. And I think the labor market has been a big part of that story, where we've seen a large influx of supply, and I think that's helped cool the wage pressures. But I still think that last mile, so to say, is going to be more difficult, and you are going to see more softening in the labor market. So that's where that pain comes from. It's not that we can't get to 2% in a timely manner, but I think it is going to take a larger slowdown in growth and more deterioration in the labor market to squeeze out that last percentage point or so of inflation relative to target.
You said you've been surprised by the pace of some of the disinflation, and that you actually have been pleasantly surprised at how much this and how quickly it's going. Does that mean that you also think that the unemployment rate is going to climb more than you previously did, and significantly more than the Fed's expectations of about 4.1%?
Well, we do think the unemployment rate's going to climb more than what the Fed has penciled in, but maybe not quite so much as where we were a few months ago, just given, again, that really impressive rate of rebound in the labor force participation. And it does seem like workers are coming back into the labor force at a stronger pace than perhaps feared. And so that's taken some of those wage pressures off. But I still think that there's more scope for the unemployment rate to move higher, just given the downward momentum that we see in hiring, and the fact that you do have a larger labor force base to go on.
Sarah House, a thankless task, but we're going to go with it on a Friday. I want you to conflate this jobs report into monetary economics. If we get a single point, 145 to 150,000 non-farm payroll, what does that do to the bloodbath, the carnage in the bond market, over to what Chairman Powell's choice set is? Does your call today move the Fed if you get it right?
So I think when we look at the jobs market print today, I think if you do see something along the lines of what we're looking for, even consensus, I think that does point to that continued moderation in jobs, which has thus far been in a pretty orderly manner. And so I think you do need to fold that into some of the other data we've seen, where, obviously we focus so much on jobs, we focus a lot on inflation, but I think just given everything we've seen in the bond market over the past few weeks, I think that has to be folded into in terms of that financial conditions tightening, where to some extent maybe today's jobs numbers matter less, and that data that the Fed is looking at it also has to be folded in terms of that financial conditions.
Mike McKee emails in, he says, ask her about UAW. You got to help Mike McKee here. He's going to do this at 8:30 this morning. Is UAW play into this, or is this next month's report?
That's next month's report. So the strike began partially through the survey week, so those workers were working for part of the payroll week. So we really need to have it go through that next survey week, which I believe runs from October 8th through 14th. And remember, though, it's not just the striking workers that would at least get knocked off those payroll numbers for October's if we see the strike extend, but it's all the workers that have been laid off in relation to that strike as well. So there's the two-prong effect of both the actual striking workers, how that feeds into areas in terms of like the household survey versus the payroll survey, but also those laid off workers, which I think we have to factor in terms of that moderation in the coming months as well.
How much, Sarah, are we seeing just a skills mismatch, where we could see potentially wages continue to accelerate even as the unemployment rate goes up, even as there are layoffs of certain types of staff?
I think that's part of it in certain sectors. If you look at the construction sector, so that's been an area we're continuing to see pretty decent hiring, but that sector's really had, I think, chronic labor shortages just from the skills mismatch and not seeing as much of those vocational trades. And so I think that's a persistent issue in some of those skilled trade issues, but I'm not thinking that that's a big part of the overarching tightness of the labor market. And I do think just as you continue to see demand slow, we'll see those pressures come down, since I think the skills mismatch is pretty limited to a few sectors and industries.
Sarah, thank you. Sarah House there of Wells Fargo on the jobs market going into payrolls. That report just around the corner. Their estimate over at Wells, 150. The median in our survey, 170,000. If you want to know what the prediction is for unemployment, looking for that to fall back from 3.8 to 3.7. Citi, top end of the range, looking for 240,000 for the headline number. Looking for unemployment to come back down to about 3.6. Going into all of that, equities slightly elevated on the session, down slightly on the week. On the S&P, positive by 1/3 of 1%. On the S&P 500, yields higher by a couple of basis points. The prospect of 5 consecutive weeks of yields climbing on a US 10-year yield, 473.60 over that period, up by around about 60 basis points. And an important conversation that Bramo had yesterday with the San Francisco Fed President, Mary Daly. Lisa, is that a replacement for the potential of one more hike from this Fed this year?
She said potentially yes. If things stay at this level, that all things being equal, the bar to raise rates is that much higher. And it could replace essentially a rate hike, so it could keep them on hold for longer. It sort of speaks to what Sarah was talking about, where financial conditions tightening is something they take into effect. Rich Clarida saying something very similar. The bond market's doing the work for them. She leaned into that. She's a non-voting member, but she leaned into that idea.
Did you get the feeling she thought this was orderly? She thought the way we've repriced is okay?
Yes. I got the sense that she's seen nothing disorderly that should get her attention. It didn't seem like anything was breaking to her. And what I find interesting about that is some people will find that disappointing. Michael Hartnett, for one, among others, looking for something to break. She doesn't see it.
Yeah, I think break is an operative word here. As people, obviously institutions are going to try to perform a controlled, a calming force. Daly's very good at that. But yeah, there's some real emotion here about break or jump condition. That'll happen at 8:30. We'll just have to see what the date is.
Up next, a piece of Lisa's conversation with the San Francisco Fed President, Mary Daly, at the Economic Club of New York. Live from New York City this morning. Good morning. Equities positive by 1/3 of 1%.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Connection lost.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
But I do think something has cracked, and for the first time in my lifetime, people are actually questioning the trajectory of where treasuries are going to be, and that is very concerning to me because every financial bubble that we've ever had has always come when it's a safe asset that breaks. The ability for markets to move very quickly is very high.
That was Peter Chi of Academy Securities. Just absolutely fantastic. A clinic on fixed income yesterday. Some of the concerns he has out of the distance and why he's bullish near term. You try and make sense of that when you listen to it on Bloomberg.com and on the Bloomberg terminal. Let's turn to some of the price action for you on the S&P 500 on this payrolls Friday. A lift here of 1/3%. Yields higher as well by a couple of basis points, up 2 basis points to 473.60. In the FX market, on the week, the euro is negative 0.1% against the dollar. This would be week 12 of euro weakness against the US dollar, 105.60. We're trying to do something about that right now, up on the session by 0.1%. This one could turn around with the payroll story, the estimate 170,000. I want to talk about this story as well, Exxon and Pioneer. The Wall Street Journal reporting overnight the prospect of a $60 billion deal. According to a person familiar with the matter, Exxon in talks with Pioneer Natural Resources. TK, Pioneer up by about 11% this morning. Exxon down by close to 2%.
Yeah, synergies. This is all about scale. We've talked about it. And let's be clear, this is not a great zombie roll-up. This is a hugely profitable company. You mentioned it earlier, Mr. Sheffield is looking to exit, to retire. And what I find fascinating here, and it's an Allarian thing, the game theory is not pretty. How many people out there can actually buy Pioneer? You're not going to sell it to the Saudis. That's politically not acceptable. What's the choice set of people he can unload this puppy to? It's a small group.
Well, speaking of the people involved, Tom, we've got Darren Woods over at Exxon, looking for a dance partner, looking for something to buy. You've got Scott Sheffield over at Pioneer, looking to retire.
Yeah.
The timing of this works, doesn't it?
The timing works, and I haven't done the actual cash cost here, and we'll get into the synergy in a bit. We've got some other things to deal with. But the answer is it's pretty cookie cutter. It's a different industry. It's not like, General, what was it? The merger, they bought Wella Balsam in Europe, Procter & Gamble.
Right.
Bought shampoo in Europe. You know what? That's a little bit marketing and squishy, and will they buy the new Irish Spring soap? This is much more cookie cutter.
This is different, I'm with you. And it comes at a time where crude has had a really difficult week. On the week, WTI crude is heading for its biggest weekly loss going back to March. Much more on that a little bit later. I want to talk about this bond market, Bramo. Yields at the moment on a 10-year, higher by a couple of basis points, 474. What a week it's been for the bond market. And a big question, what does it mean for this Fed?
Especially because you have seen it, and what did feel disorderly for a minute, for a hot second, and now we've sort of repriced and stabilized, and yet we're still at 4.74. That to me is sort of shocking. I don't know. I was yesterday speaking with San Francisco Fed President Mary Daly at the Economics Club of New York, and she talked about this. She basically said that if yields stay at these levels, it essentially would be the equivalent of a rate hike and might remove the need for them to do anything. She also talked about banking stress, the commercial real estate market. Take a listen to part of our conversation.
The bond market has tightened quite considerably, over about 36 basis points since we met in September. Well, that is equivalent to about a rate hike, right? And so then the need to do tightening additionally is not there. So from my own perspective, that's what I look at. That my job as I see it, our job as I see it, is not to tighten, just do our part. It's to watch financial conditions, because monetary policy works. We raise the funds rate, and it moves through all the other interest rates. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Yeah,
Does that make sense?
Absolutely. And Rich Clarida said today that the rise in yields actually does the Fed's job for it. Would you agree with that? Would you sympathize with that kind of sentiment?
That is actually how it works, right? If financial conditions tighten, I mean, one of the things that's happened in the last 90 days and certainly in the last few weeks is that financial markets have collectively seemed to take on board a variety of things. But one of the things that I heard from many commentators and many of the market outreach I do is that they have a general understanding now that we are committed at the FOMC to keeping rates higher for longer in an effort to bring inflation fully back down to 2%. And that recognition, along with all the other factors we could put in a list about why bond yields have risen, are affecting certainly the financial conditions and the tightening. And I see that as a positive outcome, that we would have tighter financial conditions, because then we can really get the job done of putting inflation back to rest.
Back in March, when there was this concern about the banking situation, yields were at the low of March, were about 150 basis points lower than where they are now. Are you seeing the same type of financial distress today that you did back then, even on the peripheries? How do you rationalize why it hasn't materialized in the same kind of way.
So March was a unique situation, and we want to learn from that unique situation. But it was a unique situation in this way: we had a bank run, a very old-fashioned but true bank run, where the bank's liquidity was completely squeezed, and it went. It dissolved in a period that was it was short, rapid period of dissolution, and then that spilled over to 2 other banks. And that was the extent. Now, one of the things I always remind people of is we have over 4,000 banks in the country, and 3 failed. And all other banks that even felt the stresses, and there were a large number that felt stresses because they were near neighbors in sort of size and balance sheet, distribution, composition. They felt stresses, but they managed those stresses. Since that time, banking stresses have really not been something that when you ask people in the community or the business leaders, what are you top of your worries? That is not something they list. They list inflation, uncertainty, et cetera. So I think one of the reasons that we are seeing this yield rising not spilling back over is that essentially we know what's going on in the banking sector. Investor letters have been published for months saying, here's what this balance sheet looks like, here's what this balance sheet looks like, so there's not a surprise. And the second is because the banking system is safe, sound, and resilient.
People talk about a Fed put. How high is the bar for the Fed put? How high is the bar for financial distress, for the Federal Reserve to come in and to cut rates and to take actions to add liquidity to the system? How much higher is the bar at a time where inflation is still running at the levels that it's running?
I hear a lot about the Fed put and this. What I really would do is we have tools that can be used, and the tools we use for financial dislocation are different than the tools we use for monetary policy, and both can occur. So we shouldn't have to give up our promise to the American people, our commitment to achieve our mandated goals and bring inflation back down to price stability because we have some dysfunction in the markets. But I, right now, don't see dysfunction.
Timely conversation with the San Francisco Fed President Mary Daly alongside Lisa Abramowitz at the Economic Club of New York yesterday. Catch the full conversation on Bloomberg.com and on the Bloomberg terminal. 2 parts to that conversation. 1, what does the sell-off in treasuries mean to Fed policy? And 2, slightly connected, the dysfunction we've seen in the financial sector over the last year. Let's pick up on the banks, Bramo. San Francisco and that Federal Reserve at the heart of what we saw play out earlier this year.
And she's basically saying, this was a very specific situation. There were only 3. But she also talked about the program that they put in place where they can basically take treasuries on their balance sheet and relieve them and relieve banks of the implied losses, the mark-to-market losses of those securities. That is allowing the lack of financial distress at this point. So at what point, are we looking at something that is essentially being supported by Fed policies to this day because of some serious mark-to-market types of changes in the market?
That's a key point. I'm going to give a major slack on data dependency. I know I'm an outlier. You two think they're supposed to be more omniscient. But the fact is the facts have changed. And all of them are going to be diving into mark-to-market versus non-mark-to-market losses, a myriad of themes there that they have to guesstimate as they go to the November 1 meeting.
Well, let's put that together. The unrealized losses have got greater. But ultimately, because of the policy response earlier this spring, Lisa, are these banks, this system, well insulated to that, despite what's happened over the last couple of months?
That was the implication. That was the implication, that there's not necessarily any evidence of financial distress that would cause some sort of cascading effect. And, she does talk about how they do have, surveillance and they do oversee everything. What I find interesting is, at what point do some of the tools that the Fed use, do they kind of have a stimulative effect in a sort of de facto way because they keep things from breaking the way that many people think otherwise naturally would happen?
It's 6:55. Can we digress away from the stories, the exhaustion of this
What would you like to discuss?
For those of you in America, this doesn't happen except in the world of John Farrell. He will now describe it here. Kenilworth Field, 11,000 people. The Tots Stadium, which I've been in, 62,000 people. Only in your world do the Tots travel to play at Luton.
Do you want to go to the game?
Of course, I tried to get tickets. Levy said I'm not on speaking terms with you.
I can't explain that in about 10 seconds, TK, but it's phenomenal to see them in the Premier League.
This is history.
From New York City, this is Bloomberg.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
The top names in business are on Bloomberg.
The market is starting to look over the Fed's moves into falling interest rates.
We actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to start cutting rates by March of next year.
You get a price spiral when labor markets are tight. In manufacturing, labor markets are still very tight right now in the US.
Nobody covers business like Bloomberg. Context changes everything.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
It feels like something's cracking.
I think it's problematic for the equity markets that you're having such convulsive moves in the bond markets.
These high yields are starting to spread into credit.
We are not calling for a recession. We think that call is premature.
The economy is not going to be able to handle these rates, but the Fed is going to be the last to admit that.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market positive by 0.2% on the S&P 500. It is all about the payrolls report in the United States of America. The estimate right now, TK, 170,000.
Really critical, and of course the overlay here, the bond market is substantial. We're going to report on that. John will do the data check here in a moment, but I'm sorry, the data this morning continues to show stress in the bond market. This is a different jobs report because of what we see in fixed income worldwide.
The data, 90 minutes away. Lisa, the range, 250 at the high end, 90 at the low end.
It's so funny to me that we trade so significantly on different misses or beats on these particular data because it gets revised downward or upward by 150,000 every other month.
Are you spoiling Payrolls Friday?
I am going to spoil Payrolls Friday. I mean, this data gets revised, so people are looking for a signal at a time of incredible uncertainty that everyone's uncomfortable with. Nobody likes uncertainty, and so that's where we're at right now.
Are you stepping aside and taking the rest of the morning off?
Yes.
Skipping Payrolls?
See you later. No,
Okay.
kidding. No, I'm going to be here, and I'm going to parse through it, and I'm going to explain why it suddenly is important at 8:30 a.m.
Can't wait for that, Lisa. We'll turn around from Bramo in about 90 minutes' time. Let's talk about this equity market. Futures look like this morning, positive by about 0.2%. Yields are higher by a couple of basis points, 474.43. Tom, to see the euro facing a 12th week of weakness against the stronger dollar.
Yeah, and as you mentioned, there was a 104 print earlier, and I was going to say, John, people are modeling out 102 or even parity out to 0.95, but to 1.00. But what I would suggest is we don't know on the Bloomberg Launchpad what's going to move next. I would just assume, and I think the media is really caught up to what we've said all week about price. We're going into this jobs report looking at equities, bonds, currencies analysis in a completely new way in fixed income price-based.
Missed an asset class, commodities, so let's talk about it. Crude this week, potentially the biggest weekly loss going back to March, but we're getting some deals done, potentially, between Exxon and Pioneer. According to the Wall Street Journal overnight, the potential for a $60 billion deal. Pioneer, Tom, positive in early trading by 12%.
Thank you. I didn't know there was a 12% pop. I've seen model out a 15% pop, so that 12% makes a lot of sense.
Exxon down about 1.6%. Much more on that story through the hour. Some fantastic guest lineup. Priya Misra of JP Morgan Asset Management are with us around the table to break down this bond market. Ellen Zentner of Morgan Stanley later on this hour, Bramo, to talk us through payrolls.
I'm so looking forward to that, and just to understand the importance of this. And Priya Misra, her first interview after moving jobs, I'm very pleased to say. 8:30 a.m. U.S. jobs report does come out. We will parse through the numbers. It is very important. I don't really want to diminish it. However, I do think that the revisions have raised some questions about how much we can bank on one print, ADP, for example. The market still will. Unemployment rate is expected to go, say, at 3.8%, but the market expects a 3.7% decline. 9:45 a.m. This I really am looking forward to. The U.S. Acting Labor Secretary Julie Su is joining Jonathan Farrow on Bloomberg Television, and I really want to hear what she has to say about parsing through the power of labor, wage increases, and the tax on the broad consumer of inflation, and pairing those kinds of ideas together. And at 3 p.m., U.S. consumer credit for the month of August. Consumers have been fueling a lot of the recovery, and at what point are they doing it on debt that is in an unsustainable fashion? And that's the reason why, to me, the revolving credit, the credit card debt, is going to be really interesting.
Lisa, thank you. With us around the table. Been looking forward to doing this. Priya Misra, Portfolio Manager at JP Morgan Asset Management. Priya, congratulations on the new seat. Welcome to the program.
Thank you.
I want to go back to a call you made earlier this year. The yield curve inverted for the whole of 2023. We've had some real steepness kick in over the last couple of months. Is that still the call for you through the year end?
You know, I think we can stay inverted. I do think that the steepening has been sort of a very interesting type of steepening. It's been bear steepening, which means rates have risen, led by the long end. I think it's a very dangerous sort of steepening because the long end is what ultimately the economy depends on. I think the fact that this has been a real rate-driven move, I think the bear steepening actually makes a hard landing much more likely. I do think the curve is going to keep steepening. You know, whether it steepens between now and year end, we're just talking 3 months. We might stay inverted. But I think at some point, the curve is going to have a massive steepening when the Fed finally realizes between the bond market, between what the Fed has done, between QT, the Fed is continuing to tighten, it's going to tighten financial conditions to the point where the economy does head into a hard landing. So I'm in the hard landing camp. I know the economy has been strong, resilient, and I would argue it's because we don't quite understand the lags. You know, I think the Fed's been saying that the lags are shorter. I actually think the lags are much longer because we had COVID savings. We also had essentially locked in our mortgage at a very low rate. At some point, people have to move homes or that savings runs out. That's when the consumer starts to slow down. I think you get that big steepening once the Fed starts to signal rate cuts. I don't think that's happening anytime soon, though.
That's a different kind of steepening. That's the bull steepener.
That would be a bull steepening, exactly.
This has been the bear steepener. You used the word there, and there's tons to unpack. You said it was dangerous. What is it that you think is underpinning this move at the long end? Not the consequences of it. What do you think is underpinning this move at the long end?
That's a good point, because I think a lot of people are saying there is ultimately supply. we've had Treasury supply for a long time. I actually think it's the buyers stepping away. It's not that there's supply. I mean, we have a long-term debt sustainability issue in the US. But why have the buyers stepped away? I think the buyers have stepped away because we heard from the Fed loud and clear, higher for longer. The Fed signaling that the bar to cut rates is actually very high. They want to absolutely make sure that inflation is down, that their inflation expectations don't get unanchored. I think that September Fed dot plot, it was a very strong signal that the Fed wants real rates at 2.5% all through next year. I think that's what the market heard. The buyers stepped away. And I think that's when the supply narrative, which is why it's been a long and 5 to 30 year sort of move.
Bob from Park Avenue emails and he says, do some math, Tom. Let's do some math pre-Amizra. You nailed this inversion. We went in 2021 straight down. We're at 3.1 standard deviations. Basically, we've never seen this train wreck. We've gone from 106 basis points of inversion to 30. And what everybody wants to know from you is the path forward, linear or non-linear? Is it within stability from 30 on up? Or is this now where the really heavy lifting clicks in that can affect the economy?
So, I'm going to say it depends on the data. Given that the data is slowing down really slowly, now, I think recessions are always nonlinear events, meaning when it slows down, it's going to slow down really fast. I'm not sure today is the day. So I think we can stay around this minus 30, perhaps get close to zero. To get to that plus 100 basis point steepening, plus 200 basis point steepening, I think we need to see signs of
Okay, but what people want to know is what's the path from negative 30 beeps out to negative 20 beeps? What is that? What's the ramifications of that for the fixed income market?
I think if it happens in a bear move, I think that's much more negative, not just for fixed income. I would argue it's negative for credit. It's negative for every risk asset. I think it's been a treasury market move. It's going to morph into a risk asset driven move. When risk-free real rates, and I'm going to argue it's the real rate component that's much more dangerous, risk-free real rates rise that much, I think you have to reprice risk premiums across the risk asset spectrum. So I think we'll be watching it all risk assets now.
So you're a bond bull. You've been a bond bull for a long time. We're looking at the sustainability of 4.74% on a 10-year Treasury yield. What could you see in the economic data that would make you rethink whether yields really will come down as aggressively as you believe?
So our risk scenario, which we've been debating a lot, and you can imagine the last month debating it even more, I would say signs that R-star or neutral rate, I was trying not to geek out on R-star, but if there's signs that long-term productivity is high, that the supply side effect is here. So if you get another big increase in participation today, if you start to see, population growth of the labor market or productivity numbers start to rise, then perhaps there's been some structural shift. I think that's the big debate we've been all grappling with all year. Is the consumer resilient because the lags are longer? Has there been a structural shift in the labor market? We've become more productive, AI or some reason, and so we can actually handle higher real rates. I'm not convinced we've seen anything in the data on that front, but if we start to see that, I think we'll question what is true level of restrictiveness. I think I would argue 2.5 is very restrictive on real rates, but perhaps we can handle if there is this, essentially this sort of structural shift in the labor market.
Do you buy the idea that if that is truly the case, that risk assets can hang in there? Or do you think that eventually, even if there is this increased productivity, that you cannot have 20 years of zero rates suddenly just easily morph into a new era of higher neutral?
Exactly, and you have to think about risk premium essentially as well. So I hear your point. If we are more productive, maybe risk assets are okay. But how much should I get paid up for the uncertainty? If Treasury risk-free 10-year Treasuries are giving you 5%, perhaps I want 9% to take on credit risk, and that's where high yield is. Maybe I want 10%. So I do think there's going to be, even if it is a productivity-driven move, which means that that's going to be the new normal, well, then every other risk asset should be pricing in the fact that treasuries are more liquid. I also worry a little bit about liquidity risk. It's never appreciated until times become volatile like they are right now. You've got to pay up for that less liquid asset.
Let's talk about demand. You said that the buyers have stepped away. Can we discuss the sources of that demand and how temporary you think that is? Dalip Singh of PGIM talked about the loss of maybe predictable sources of demand. China. Things happening elsewhere. The Federal Reserve, for instance. Do you think we need to think about the character, the shifting character and personality of that demand? Has that changed?
Absolutely. So I think whether you think about the Fed or the central bank community, or I would argue the U.S. domestic bank community, they're sitting on massive unrealized losses. U.S. banks were significant buyers of treasuries. Who's the marginal buyer? I would say it's asset managers. And asset managers might be able to take a view here on rates, but they are also a function of inflows and outflows. My biggest concern right now is, do we start to see outflows from bond funds? Bond funds had massive inflows this year. I would argue, maybe I'm biased being at a bond fund, that there should be more inflows, because if you're looking at the fact that the risk asset complex is finally paying attention to interest rates, maybe you should have some treasuries or bonds in your portfolio.
That's the pitch.
But if the outflows begin, bond funds will become forced sellers. They may still have the view that a hard landing is coming, but they'll have to sell. So I think watching those weekly bond fund inflows, I think they were important all along. They've become a lot more important now.
Do we need to get used to big moves then in treasuries? Do we need to stop overreacting to 5-10 basis points on any given day? Is that potentially the new normal?
The swaptions market is saying that the new normal now is 8-9 basis points. I think that's fair. We're in an extremely complicated environment. The data is not very clear. The Fed also, I think importantly, is telling us that we're not in any rush to cut rates. So in this data-dependent world, I think volatility, uncertainty is going to be high. That's why I think liquidity is actually important, and investors should pay attention to making sure you've got liquid assets in your portfolio. So in a 10 basis point move, you don't have to actually sell assets. You've got those liquid cash.
Priya, this was fantastic. If you are just joining us, it is Payrolls Friday. Equities on the S&P 500 positive here by 0.2%. Yields a little bit higher by a couple of basis points, 474.22. TK, a lot to think about there with Priya Misra.
A lot to think about. Forget about the math, because she nailed it with the emotion. And this goes to what Chris Whalen, who's expert on banking, said the other day. There becomes a silence. And the silence in the Misra analysis is where long-only buy-side asset managers come in, and there are liquidations from retail and institutional. And that silence is in an office when you look at your Bloomberg or you look at your blotter and go,
oops.
Oops. And Priya nailed the process that we've seen before.
Just to be clear, Priya, not the base case for you, I assume.
Absolutely not. I would argue that there's value in bonds here. You're supposed to hedge the risk asset
you sound
in your
like Bob Michael. You know, that's good.
I do work for him.
Okay.
Priya, it's good to see you. Priya Misra of JP Morgan Asset Management. Priya, thank you. Coming up in the next hour, Nadia Lovell of UBS on this equity market, as we are poised for a 5th consecutive weeks of losses on the S&P 500. That can all change this morning with one data point a little bit later at 8:30 Eastern Time. The payrolls report just around the corner. 170,000 is the estimate. To weigh in on some of the politics of all of this, the strikes, not just in the auto sector, but in healthcare as well, we can catch up with James Lucia of Capital Alpha Partners. All of that still to come from New York City this morning. Good morning.
Not selling the Patriots, you're not selling the packaging company. I guess you don't like to sell things, right?
I really don't. We try to create a family environment in everything we're involved in. People want to be part of something that's bigger than themselves.
From New York
York City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
The border wall, the money was appropriated for the border wall. I tried to get them to reappropriate, to redirect that money. They didn't, they wouldn't. And in the meantime, there's nothing under the law other than they have to use the money for what was appropriated. I can't stop that.
Do you believe the border wall works?
No.
What a crazy exchange with the President of the United States. TK, they're going to start building the wall because they have to, but they don't believe it works. What do you make of the exchange in this country in the last 24 hours on the southern border?
Within the time constraint of morning TV, I'm not going to sit back and do old fart stories, but the bottom line is I have a crystal memory of the day Ted Kennedy of Massachusetts and Carlos Gutierrez of the Bush administration went down in flames. Why? They don't have the votes. And from Pritzker's, Illinois, to what you're seeing with the president in the Oval Office, the Democratic Party realizes they don't have the votes. Much better on the Sunday talk shows. Margaret Brennan will kill it on Face the Nation, etc. They don't have the votes. Simple as that.
Much more on this a little bit later. Let's turn to the price action on this payrolls Friday. 170,000 is the estimate. The price action going into it looks like this. A little bit softer on the week, firmer on the session, up by about 0.25% on the S&P 500. Yields higher by a couple of basis points, Tom, 474. Crude's had a terrible week, down to 82 on WTI, potentially the worst week going back to March.
We're going to advance this, of course, with what we see with this potential merger in the Permian Basin. We'll get to that through the morning, and somehow I don't think the story of a $60 billion transaction will go away. Joining us now, and this is beyond timely, James Lucier joins us, Senior Political Analyst at Capital Alpha Partners, a veteran of the Washington Wars. James, this is going to be a 2-hour conversation. Bramwell said I got to back it up to an hour-and-a-half conversation. There's so much going on. Let me just begin. I know John wants to talk Jobs Day and the strikes. How do we get to November 17th this leaderless?
Well, the point is there's nothing to look for but a shutdown on November 17th, I think. There are 2 candidates for Speaker in the House right now. Neither one is close to locking up the votes. It's a good chance that neither one will lock up the votes. And the Speaker race is going to take a very long time to sort out. And while they're sorting the race out, the House is basically going to be paralyzed on everything having to do with appropriations or continuing resolution or Ukraine or any of those topics.
If they're paralyzed, what is the impact on the President of the United States?
Well, the President of the United States is just fine. You saw him there. He is in full command of his executive powers. He can do as he likes. The issue is not really that the House isn't meeting. The issue is that without a functional speaker, you can't bring legislation to the floor. And without someone who is an elected leader of the Republicans, they really can't broker the deals they need to make on appropriations bills or continuing resolutions or, again, Ukraine. So the U.S. government is working just fine. It's just that anything that requires a decision from the House of Representatives is not going to happen, not by next week, probably not in 2 or 3 weeks.
James, what do you make of this whole border wall issue? The fact that President Biden came out yesterday and basically said, my hands are tied. I have to finance this thing that I said that no more money would go to this. Is this basically a way of him having his cake and eating it too, coming to some compromise and looking like he's doing something about the border without having accountability?
Well, it's a tricky issue because there's not going to be any funding for Ukraine unless there's some movement on the border. I think that if you parse what the House Republicans are saying, they're not categorically opposed to Ukraine in all circumstances, but they want to see border funding at the same time. Meanwhile, if you look at the polls, Republicans are currently at a 40-year advantage over Democrats in issues such as immigration, the economy, and crime. It's really ironic that Republicans have such a commanding lead in the polls on the top issues that voters care about, and yet they're completely feckless in the House. They're wasting this opportunity. I think this in part is a defensive move by the president to deal with the issue as best he can.
Based on what you have heard, there's a lot of disagreement within the Democratic Party about how to go about reforming immigration policy, which may be why President Biden is trying to lean into one idea and say that it's out of his hands. Are you hearing the Democrats coalesce around anything concrete with respect to immigration policy and having a serious conversation about it?
I think they are. I think that the first thing, the most important and hopeful thing, is that at this point, both Democrats and Republicans recognize that there is a problem here and that there is something that needs to be done. Now, would Democrats go for a border wall? Maybe not. Would Democrats want punitive treatment? Maybe not. But everyone agrees that there needs to be some mutually agreeable package here.
Okay, well, what is it? You've got decades of experience of people agreeing to disagree. I'm fascinated, James, with great respect for your work at Prudential for years. Where's the compromise on immigration? I, frankly, with respect, don't see it out there.
I'm not sure I see it either. I think that simply putting some numbers on the table, more dollars for border enforcement would probably go a long way. Restoring something like the Remain in Mexico policy might go a long way. Modifying
Okay, but James, I don't mean to interrupt, but we spoke with the governor of Connecticut, who's a little bit removed from this, Lamont of J.P. Morgan, and of course all of his, focus in Connecticut. It's a unique story, to say the least. Governor Lamont told us, stop them at the border. Isn't that the national attitude?
That is the national attitude, absolutely.
I'm fascinated how we legislate stop them at the border. Have you heard a theory?
Well, again, more money, border technology. I think the problem with the wall, more than anything else, is that President Trump made it so iconic, so totemic, that it's untouchable for Democrats. But, everyone agrees that the situation in cities like New York, Boston, cities across the country is becoming untenable because it's not just the frontline border states, Texas and Arizona, that are dealing with this flow. It is now downtown New York.
James, when you talk about how the Republicans have been unable to really capitalize on this, where do you see some of the discussions going in the House and the certainty of a government shutdown come November 17th?
Well, I think the shutdown is fairly certain because there's been no progress whatever on moving appropriations in the House or the Senate at this point. The real question is how the House could possibly pass a continuing resolution on November 17th. I do think that something will get done eventually, because what's going to happen is that the Senate will pass something, send it to the House, and that bill from the Senate will eventually be moved by means of what's called a discharge petition. So I doubt any shutdown is going to be more than a couple of days, and there is a mechanism for resolving it quickly. But if you see a potential speaker like Jim Jordan, a Jim Jordan speakership is not going to be one that is congenial to getting a CR done. So, I think we've got to count on a shutdown, assume it lasts a few days until the discharge petition kicks in, but the next one is going to be longer and harder.
So, James, just to put a bow on it, just to jump in, you get Jim Jordan, base case shutdown?
Yeah. Yes. Well, actually, my base case is shut down no matter who wins right now. I think that while Scalise and Jordan are the leading candidates, neither one is certain. There could be a third person, but I just don't see how anyone will be ready to handle the CR by November 17th. I hope it's a short shutdown. But what worries me is the prospect of multiple shutdowns after this and a major showdown on a large appropriations bill or series of appropriations bills at the end of the year.
I think we all hope we don't have to talk about it anymore, but I think we expect we will. James, thank you. James Lucy there of Capital Alpha Partners. TK, base case shutdown. He's not alone. I don't think it's contrarian. Then that's around the consensus going into November 17th, isn't it?
Let us remind ourselves, and I have the image of walking into Ames, Iowa, into real wrestling years ago, John, which I can't even explain to you the impulse of that. Jordan is a legit Division I stud in wrestling. the football equivalent is like he won the Rose Bowl and scored 3 touchdowns.
Are they skills he's going to need when he's playing?
Those are skills. Lucier, I've known Jim Lucier for years. He is the most deadpan analyst in Washington. And the backstory here is we're going to have a wrestling star. I mean, this guy's heavyweight with an economics degree, I might point out. But Jim Jordan, in his shirt sleeves, wrestling the house is going to be absolute original history.
I think his demeanor, Lisa, captured the moment, didn't it? It's how most people feel about this story.
It's just basically resignation and basically, you know, they're kind of ironic amusement as you watch.
A lot of voltage there.
1 hour away from the payrolls report. Ellen Zedner, Morgan Stanley, coming up.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. ON's running shoes have a unique look, and so does its leadership team. CFO Martin Hoffman is also co-CEO, and he thinks 2 jobs are better than 1.
How do you balance those 2 roles?
I feel the CFO makes you a better CEO, and the CEO makes you a better CFO.
Watch Chief Future Officer this Wednesday on Bloomberg.
60 minutes away from the payrolls report in the United States of America. 170,000 is the estimate in our survey. Your equity market going into it slightly positive on the session, down on the week, up by 0.2% on the S&P 500, up by 0.22% on the NASDAQ 100. In the bond market, phenomenal moves over the last couple of months. 474.22 on a 10-year, up by 2 basis points today, heading towards 5 consecutive weeks of yields climbing, Tom, on a 10-year maturity.
I think we need to frame this right now. It's so important, is that that problem in bonds sustains this morning. It's ever so slight, but I got yields set higher this morning. I got 210 spread like a rock at negative 30 basis points. And as Priya Misra talked about, I got a 10-year real yield higher this morning, 2.43%. So there's that tension into the report.
Speaking of tension, we had a 30-year nominal yield through 5% earlier this week, 490.67 at the moment, up by a couple of basis points. The fate of this bond market, today at least, potentially in the hands of the jobs report, which is just 60 minutes away. In foreign exchange talk, tons about this. The euro against the dollar, 105.54. Slightly positive today, slightly negative on the week. Lisa, this would be 12 weeks of euro weakness against dollar strength if we closed here.
Who's going to go long euro right now? What is going to be the motivating factor to go long euro at a time where U.S. data has been outperforming and you have oil prices that are seriously in question? This is the challenge at a time. And I do wonder, based on the volatility and lack of conviction, a job surprise, the upside, what does that do to the euro?
Yeah, not good things, you'd imagine, based on the price action we've seen so far off the back of high yield, stronger dollar, the other way. Maybe Lagarde's sitting there, wanted it to go the other way. I don't know. I'm just saying.
You think she's trying to game the jobs market?
Just throwing that out there. Perhaps you could imagine. Could imagine.
Come on, please, please, please.
Under surveillance this morning, the US jobs report due out at about 60 minutes' time. The median estimate in our survey calling for a print of 170,000, with a range of calls from Wall Street's biggest banks. Citi at the high end, 240, Wells Fargo at the low end, 150. We'll catch up with Alan Zentner of Morgan Stanley in a moment. 180, that 240 over at Citi. Andrew,
talking to the different opinions, and to go from Wells Fargo to Citigroup here shows that the efficacy of 1 over the square root of n, the standard error of this report, is ginormous. It's embarrassing how everybody has to be certain, but they're really not certain.
Let's talk about a deal, the potential for one.
Yes.
Exxon nearing a takeover of Pioneer in what would be the company's biggest acquisition since merging with Mobil back in 1999. The deal could be worth as much as $60 billion and may be finalized in the coming days, according to the Wall Street Journal. This morning, Lisa, Pioneer up by 11%, Exxon down by about 2.4.
So synergies here in the shale patch, I believe it values the shale patch at, what, $60 billion or something of that nature. At this point, I do wonder whether policymakers in the U.S. are going to sign off on this very happily to say, if we can have something that's as efficient to be competitive with the Saudi Arabian OPEC Plus complex, well, kudos to us, because go back to the energy independence, that might be what people are looking for after what we've seen over the past couple of years.
Do you get a seat in Vienna if you're producing 1.2 million barrels a day? If you're a country, you probably do.
If you're a country, you do. I don't know. I doubt it. I highly doubt that they want to really include this particular part of their club.
Amazing. Amazing to see, Tom. Just an absolute monster.
Yeah, we're so time compressed with the news flow this morning. John, let's do it real quickly. Scott Gruber's at Citigroup. He was at Sanford Bernstein with Ben Dell and their fabulous hydrocarbon team, and he and his team put out a blistering note this morning of how the pros look at this transaction. They do not look at what the media is looking at. They say to themselves, if you take out a set of synergies, what are they buying on West Texas Intermediate equivalent when they buy Pioneer? And the answer is they're buying a blended average, this is my approximation, of $69.25 West Texas Intermediate, and then Citigroup sets that up to their $78 bogey, and they say that's the arbitrage where Exxon comes in and they get a gross up off the post-synergy value.
WTI,
that's how the adults look at it.
Right now, Tom, 82, Brent crude, 84. Let's finish on this story. Tesla cutting the price of its Model 3 and Model Y cars in the US after its third quarter deliveries missed estimates. The Model 3 and Model Y cars account for the bulk of Tesla's sales in this country. The stock a bit softer here by 1.4%. Lisa, I've now lost count.
Exactly.
How many times this has cut both ways this year so far?
But this comes on the heels of a disappointment when it comes to deliveries. And that, to me, is really telling. It is also telling when you have BYD, basically, of China, eating their lunch. I mean, they are selling cars at a much lower cost point, and they have the backing of the Chinese government. And so what's Tesla's game plan at this point? What is their edge?
What is the brand destruction of the uncountable price cuts? I just don't get it. How do you feel if you bought a Tesla, whatever, X months ago?
To be honest with you, I'm not thinking about Tesla or the Chinese manufacturers. I'm thinking about everybody else. This is a war between some people who can have that war, Tesla, the Chinese manufacturers, everybody else. This makes it very painful for Detroit's big three to get what they're trying to do off the ground, Tom, up and running to compete with Tesla and the Chinese manufacturers.
We begin our jobs coverage. We do so with Ellen Zentner, Chief U.S. Economist here. We go into the next hour and then beyond. I want to go to your wheelhouse, which is your reading for the years you've been doing this of the American consumer. Into this jobs report with a summation of Morgan Stanley research, including an analysis of small business. How flat on their back is the American consumer?
So I still think that the lower income consumer is struggling. I do think with their real wage growth turning positive as inflation comes down, it's been getting better. But job growth is slowing, so overall labor income is slowing, and that predominantly drives spending. Credit quality is still good. And you can see that delinquencies are rising among subprime consumers, lower credit quality segments. And you could breathe a sigh of relief and say, yeah, but it's only just risen back to pre-pandemic levels, except the pace at which that deterioration is occurring is worrisome. We don't think the bottom is falling out of the consumer, but I think already we've seen early signs of credit card data that have really fallen off in September. And whether that's the Taylor Swift effect fading, the Barbenheimer effect fading, it's going to be seen in the numbers. And it's going to look like a tremendous loss of momentum.
The bottom fell out of the Treasury market. Can you give us an idea of what the conversations with Matt Hornbeck sounded like this week when you two were talking about what's been going on, what it means for Fed policy?
So I think there's the strategist side of it, right, which is flows. You've lost a lot of big buyers that just aren't there, including the Fed. And that's driving yields higher. From an economist's perspective, it's why does the market suddenly believe the Fed? Why do they suddenly give 110% probability that the Fed is going to be right in its forecast and deliver exactly the kind of policy restriction for this long? Tom mentioned 2.5% real yield. That's only going to get higher the longer they remain on hold. And the thought that the economy could withstand even higher real rates from here for a quite extended period of time, I just think is a pipe dream. And if I were the market, I wouldn't say, yes, you are right. You've given me the stop plot. You've told me this is what you're going to do. Why? Why are they suddenly putting all their eggs in one basket?
Well, you mentioned two things there. The big buyers stepping away and this general acceptance of what the Fed is saying. So are you saying that it's more heavily weighted to accepting the Fed's forecast and not the latter? In other words, that this is truly just a misperception in markets versus a structural change that could keep rates higher, even if, the Fed does shift gears in any way?
Yeah, so I do think that structurally real rates can stay higher for a time because we still need to be restrictive, right, in order to ensure that inflation continues to fall toward goal. You're asking the million-dollar question, right? How can you extricate the two and say, okay, this is the basis point owed to flows, and this is the basis point owed to just a difference of opinion and outlook, right? You do have to have some risk built in that the Fed is right and you're wrong, right? It just seems to be an extreme. And if I'm a policymaker, I'm looking at these moves and saying, you're doing a lot of the work for me. And so maybe I don't need to be as restrictive. There's still a lot of effects to come through to the economy from this.
From an economist's point of view, does this increase the chance of a hard landing from your perspective?
Well, I think when in the volatility that we've seen, and in particular how quickly financial conditions have tightened, if that's sustained, then absolutely chances of a hard landing go up. I mean, I know on prior shows I've come in and talked about our recession probability. We've had a soft landing call for so long. My probability of recession is well higher than my peers who only just embraced the soft landing. And why is that? Because when you think 12 months out from here, we're not out of danger. I still have a 40% probability of a recession occurring within the next 12 months, even as I've had a strong call on the economy. We are seeing things slowing, and the ugliness under the hood can come out pretty quickly.
Well, I want to go right there. You've got Eric Stein at Morgan Stanley. He's something. He was for years at Eaton Vance up in Boston. He's got some serious academic cred out of the University of SV Bodie up at Boston University. What are you learning from your bond people, like Eric Stein, that you're folding into your economics?
So that we don't think real rates are going to remain this high for this long.
How many basis points on a 10-year yield? How many basis points will they come in? You're looking at 10 beeps, 20 beeps, or a substantial?
Oh, no. Well, Matt Hornbeck, Lisa mentioned that I work really closely with, right? They're oversold. It's oversold here. right? And so I would imagine more than 30 basis points.
Bottle that.
Bottle
We
that.
heard it here. 30 basis.
On the bond market.
Zettner to the rescue.
Born back. Is she?
Zettner to the rescue.
Okay.
Come and save the day.
And then I think you're going to stick with us, hopefully. Anna Zettner of Morgan Stanley. Just to get you up to speed on some of the price action elsewhere, the equity market on the S&P 500 here, positive by about 0.1% on the S&P. In the bond market, shaping up as follows. Yields a little bit higher today, a whole lot higher over the last couple of months. Your 10-year looks like this. Yields up by 3 basis points, 4.7464 in foreign exchange. Lisa, this is the one for you, I think. 105.55. The ECB watching this one closely at 8:30 Eastern Time.
I just think that it really highlights how this has been driven by U.S. strength in addition to European weakness. Honestly, the story really is in the bond market, though. Really, whether we end up getting a similar type of jump condition upward that really does follow on the heels of this report.
I go back to that note from Michael Hartner this morning of Bank of America. Question, what is no one asking you about? Answer, 2024. Just seems to be this focus, the obsession with like the next month,
X-axis
the next
is coming.
4 weeks.
Yep, absolutely. I just did, because Zettner ordered me to, a 2 standard deviation study of the Zettner call of coming in 30 beeps on 10-year at real yield. It gets you nice through the 50% tendency and right sitting on the long-term average. That's how fast we've come up, that even if we get the Zettner move lower in real rates, we're still sitting nicely on the long-term trend.
If you are just joining us, welcome to the program. Your equity market just a touch firmer here, up by 0.1%. If you want an outlook from elsewhere, this from Citi, Andrew Hollenhorst, saying this: despite the rapid rise in Treasury yields, Fed officials are likely to maintain their higher for longer rhetoric and proceed with a 25 basis point rate hike in November. And let's build on that a little bit. Do you think it changes much, this move we've seen in the bond market in the last month?
No, I think the bond market's focused on the higher for longer theme, and whether the Fed hikes another 25 basis points. You know, the market has already half of that expectation priced in. I don't think that changes much. I have a very strong view in the other direction. I think they are done here. We've been calling for them being done here for a time, and I think you build on that the longer that financial conditions remain this tight. Right, again, going back to the market doing some of the Fed's job for it. I'm still chewing on what Mary Daly said yesterday. I mean, she gave us a mouthful, and that is the way policymakers are going to be shifting, right? Financial conditions have tightened. They've tightened in a way that leads to uncertainty. Uncertainty means the prudent step right now is to just remain on hold.
You think she represents the consensus view on the committee?
Well, I don't think that she presents herself as I am the consensus on the committee, but other policymakers are already moving in that direction.
So your disinflationary vector's in place, and it will give the Fed ability to move when? Not November, out a couple meetings.
No, I don't think that I think the next move is a cut. I think that they're on hold from their July meeting when they delivered the last hike until March of next year. And that is well earlier for the start of cuts than the market, but that's an 8-month hold while real rates continue to rise during that time and inflation is still coming down. Again, difference of opinion in forecasts.
Ellen, wonderful to do this every Payrolls Friday with you, as always. Ellen Zettner there of Morgan Stanley. Coming up at 8:30, the US jobs report and former Fed Governor, Randy Krosner, is going to join us, as he always does. In a moment, Anna Wong of Bloomberg Economics, giving us the view of Bloomberg on what to look for from the Payrolls report in about 45 minutes' time.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Access
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg. Top experts. Great questions.
We've already repriced, not just to the pre-COVID levels, but to the pre-GFC levels. So regime shift has really already happened. In our view, it's actually an overshoot, but it's already happened. I mean, we're at the Fed's target. We're not in the 1970s and the 1980s here in terms of the economic growth environment or the inflation environment. The Fed is telling you, they're telling you, we're not going to stop until it's painfully obvious that the economy can't handle it.
Kelsey Barrow, JP Morgan Asset Management, together with Bob Michael's team, Priya Misra, who we caught up with a little bit earlier, looking for a hard landing in the United States of America, particularly with the additional sell-off we've seen in the bond market. And what a sell-off it's been. Treasuries now priced as follows, going into payrolls, that data point about 45 minutes away. Your jobs market, 170,000 is the estimate. Data, your bond market, looks like this. Your 10-year yield, up by a couple of basis points to about 474.43. Your equity market, TK, positive by about 0.1%.
We just saw something there with Ellen Zentner, who I adore, which is the partition of silos on Wall Street. And the economists really don't want to talk about what bond markets are doing. And the bond market people, of course, don't want to second guess their economists and all. We don't have that luxury at 8:31. We're going to have to conflate market reaction to this report. We're going to have to conflate in real time the theme, the what if, the probability that we extend, as Jens Nordvik says, this bond carnage. And they're in their silos, they're really not anticipating that conflation.
Anand Ruskin, Deutsche Bank, a weaker number will be believed. Put out a note yesterday, actually pretty interesting. A weaker number will be believed since it would be consistent with the 3-month NFP average that has been on a steady slowing trend consistent with the sub 100K payrolls by the end of the year. So yes, these numbers can dance around, Tom, but the trend,
the vector, absolutely,
is for a little bit of a slowdown.
And the 3-month annualized, and we talk about it with disinflation and inflation statistics, but you can do the same thing with the jobs report, as Dr. Ruskin does there. I'd go to David Kelly at JP Morgan, who was the first one I really heard within the universe say, what's the vector to a negative non-farm payrolls report? It's out there somewhere.
Well, that would be a shocker, wouldn't it? I can tell you that's not even the low end of expectations today. The low is 90.
No, that would be, no.
Do you know who's the high? Ian Shepherdson, Pantheon Macroeconomics, 250.
Well, but it's because he likes Newcastle.
And he thinks they are statistical quirks. He's still looking for a slowdown. So don't take that as a bullish number from him. He thinks that's flattered by state and local education numbers, something like that.
I mean, I don't do the guess the non-farm payroll thing, but today I'd be baffled. I feel sorry for people that actually have to
blindfold top. Throw a dart. You know how this works.
Yeah, that's the way it works.
Yeah.
And along with this, that's what she does. She has a blindfold and throws it at the dartboard. Out of Chicago, and of course, the Bloomberg Economics, and we know her for one of the great calls of modern market economic history. Guess what? Rates are going up. Anna, did you ever think we would get yield up, price down, as we've seen in the last 90 days?
Well, I did warn after the Fitch rating downgrade of U.S. sovereign that the bond vigilantes might come out, given that looking at that the fiscal deficit is going to hit 6% of the GDP at the end of this year. And if the economy does fall into a mild recession, as we predict, it could easily, fiscal deficit could get to 10% of GDP very quickly due to automatic stabilizers. So, yeah, I think the U.S. Fiscal trajectory is not looking good, and it's just a matter matter of time people should recognize.
Anna, I love having you on. 3 people just drove off the Garden State Parkway in New Jersey. Anna Wong, if we get any sense, let's take a midpoint. Forget about 10%. If we go from 6% out to 8%, what does that do to the IS curve? What does it do to the real economy of America?
Well, if rates go to 8%, then there will be first a level adjustment. It is the jump from where we are right now to 8%, where the adjustment will happen. But after the economy get used to 8% interest rate, there'll be like, the now baby boomers who survived the 1980s and say, well, my mortgage rate was 12% back then. It's okay.
Lisa, I guarantee you, Dr. Wong is never going to get a job at a White House. Doesn't matter who's in charge. Wong is never going to work at CEA.
Well, Anna, on the way to 8% mortgage rates, there is a question of the labor market, which how is it going to hold up through all of this time? Why are war notices important?
Because war notices tell you where the layoffs are coming from and where it will start to show up in the jobless claims. So a big mystery right now is how low the jobless claims is, right? But war notice actually could lead the jobless claims by 60 days to 90 days, 2 to 3 months, because after people are laid off, they still get severance, and so right now what we are seeing is that the notices, war notices in Sun Belt and in Rust Belt have been rising, even as California's AI boom is causing improvement in unemployment. So I think what we're going to see in the next couple of months is more troubles in places like Arizona, Texas, Colorado, Idaho, places that had benefited from the pandemic, migration.
Why is this going to lead to a higher unemployment rate versus just simply the churn that we've seen in the economy moving over to the labor market?
That's a really good point, because I think there is some truth in the idea of rolling regression. We're seeing California, layoffs coming down as Sunbelt layoffs go up. But I think ultimately the unemployment rate in California is not going to fall fast enough to offset the unemployment rate increase in other places.
So right now, as you look for this particular report, do you agree with Ian Shepherdson that we could get a upside surprise that's just simply distorted by everything and all the technicals? Or are you looking for something to really highlight that weakness that you see in these Warren reports and in some of the shifts that you're seeing in the Sun Belt, in Idaho?
Yeah, absolutely. I'm with Ian Shepherdson on this one. I think the risk is tilted to the upside for this report. We still have a lot of catch-up hiring in healthcare sectors, but there's just so many shocks in the next couple of months that I could see a negative payroll report by the end of the year.
Anna, you've been brilliant on the y-axis. I want to take you to the x-axis right now. If we don't get the Anna Wong movements, the what-ifs, maybe the probability of higher rates, what if we just stay here with a 10-year real rate of 2.4%, that, 5-ish or under 10-year yield as well? What are the ramifications for the jobs market and American GDP?
I think if we stay here, if we don't move lower, then what you're going to see is the consumer's delinquency rate is going to rise, because the denominator, which is income growth, would be softening, but the numerator, which is interest rate compounding their debt, would be growing way faster. And so what you will see is that consumer will have problems, and then firms' profit will fall. You will have that short and mild recession.
Anna Wong, I just got a note from Andrew Honhorst, the city, an update from him, actually responding to Lisa's conversation with the San Francisco Fed President, Mary Daly. He said yesterday, President Daly suggested that the rise in 10-year yields might be a substitute for a 25 basis point hike. He says, we think the center of the committee will remain data dependent in determining whether to raise rates on November 1st. He's looking for a hike. Anna, what would you say back to that?
I think there's a substantial risk of a hike in November, and I think the bigger report is actually next week's CPI. We think there's an upside risk for a core CPI to be 0.4 due to higher seasonally adjusted used car prices. So, yeah, definitely it's on the table.
Looking for a hike, potentially, in November. Anna, thank you. Anna Wong there of Bloomberg Economics. There you go, Lisa. Start a conversation on the south side here. That conversation you had with Mary Daly yesterday. Looking for a 25 basis point hike still over a city. He does not think it represents the center of this committee.
Although we heard from Ellen Zentner that she thinks it does. So there's a sort of a split idea based on where people shake out in terms of the economic data. I think ultimately it will come down to whether the data does continue in some sort of more accelerated pace. But if that's the case, and if you get some sort of significant increase in longer-term yields, does that change the scenario even more with respect to financial tightening?
What we have been through since 2007, the third week of August 2007, as Ellen Zentner said in her note, the uncertainty of this report and its effect on the markets. Can I say we've never seen this? I have a 10 standard deviation move in the inflation-adjusted real yield. Like I said earlier in the week, it was never Tuesday, never ever Tuesday. Hey, guess what? Fridays, we're still going to Never Never Land right now on Friday.
What's the Tang like this morning?
The what?
The Tang.
The Tang is good. Tang Zero helps out. I've had problems with my feet. And the doctor told me.
Had a little bit of an accident.
Yeah, we had a little bit of an accident.
Yeah,
I was reaching for the Tang and I spilled
mopping it
over
up
here.
for you.
You know, Farrell helped mop it up. The interns helped as well. And you know, I've had to cut back on the Tang actually. You know.
That was a full cup, whatever that was.
It was.
It's all on the floor now.
It was. You know.
I cleaned your phone for you.
Thank you.
I've rescued it.
Is it
Don't
okay?
worry. I think it's just about okay.
It's a reason to get the new iPhone, right?
Nadia Lovell of UBS Global Wealth Management coming up. Your payrolls report 34 minutes away. The estimate 170,000. Equities higher by just 0.1%.
A lot of the focus on the breakthroughs were because a lot of these research labs, the OpenAIs, Anthropics of the world, DeepMinds, had this focus on AGI, artificial general intelligence. Can you build an AI that can do anything?
Yes.
And it turns out maybe you can. So
making a machine that's in our own image, in a sense, that's what AGI sounds like.
More than that, it's a general intelligence. So it's the kid that made you look bad at school because he was good at everything. You know, the top performer.
Right.
Like GPT-4 now can pass the bar exam, the medical licensing exam, the GRE. It's probably going to Stanford, you know, next fall. But then our take was, that's great. You can have these amazing giant general models. What would be better is to mimic humanity, where our companies are not one generalist doing everything. What if we made it so you could bring your own data to the models and have lots of specialists working together and have those models working for you that you own?
Right.
These models like really talented graduates that occasionally went a bit weird. It's called hallucinations or other things, but that's because we feed them bad data. So we were like, what if you had open data, open models, and allowed it to be customized and specialized? So again, like a talented graduate, and they can learn very quickly from a few examples. So they have this base of generalized knowledge. They've been through kindergarten, high school, and university, but they're not specialized yet. But you can train them yourself, or you can just show them some examples, and they learn very quickly.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the US and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that, because, you know, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
The top names in business are on Bloomberg.
The market is starting to look over the Fed's moves into falling interest rates.
We actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to start cutting rates by March of next year.
You get a price spiral when labor markets are tight. In manufacturing, labor markets are still very tight right now in the US.
Nobody covers business like Bloomberg. Context changes everything.
The ability for markets to move very quickly is very high.
The economy is still in a good place, not a great place.
I think that there are some places that are going to continue to be vulnerable.
I think we're getting closer to a point where the Fed will have to acknowledge that there's something more significant going on.
They're fighting inflation that I think is already clearly coming down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Yes, it's Jobs Day, but it's a different Jobs Day here on Bloomberg Radio and Bloomberg Television. Lots to talk about. John, I'm going to talk about the seismic shift from the last Jobs Day. Take the old benchmark before your time, 30-year U.S. bond, like 4.30%, and it's 4.90% this morning.
Well, back on the first day of last month, Tom, it was 4.18 on a US 10-year. Right now, 4.75, pushing 4.90 earlier on this week. New cycle highs over the last week.
We're going to conflate what's going on in the markets into this report in 29 minutes. I can honestly say I think it's the first time I've ever done that in all these years, and that's the level of carnage that's still out there.
So let's go through the numbers. 170,000 is the median estimate in our survey. There's a pretty wide range. At the low end, 90, at the high end, 250. 240 is the view from Citi. I keep going back to Andrew Hollenhorst, Tom, who, despite these moves in this bond market, still believes this Fed can go again in November.
Yeah, well, the debate's out there as well, and the debate's also with the Fed, and the lead on that is Lisa Abramowitz's wonderful, delicate conversation with Mary Daly of San Francisco yesterday. You know, I figured, you'd have some rubber chicken, get through lunch, have a good time. And you made some real headlines. What was the distinctive message from Mary Daly within Jen Nordsvig's bond carnage?
Well, you heard this from Ellen Zentner, that there is a financial conditions tightening that is going to offset what the Fed might have to do. That basically what we've seen in the bond market might supersede the need to hike rates again. The question is, how sustainable is this? How much does this crimp economic activity if we still see incredible strength that is surprised to the upside the way that Andrew Hollenhorst thinks? Well, then people might think, well, even if we do see that kind of tightening, it's sustainable, and we're looking at an economy with some other intense drivers that have legs.
And John, off this Jobs Day and wage growth, which is sort of the price dynamic of the Jobs Day, the question is, are we super restrictive? Are we fighting the last war?
We're going to find out, aren't we, based on the next couple of reports. Problem for the Federal Reserve, and I think the problem really for bond market investors right now, Tom, trying to work out what this data means for treasuries after the move we've already seen. Well, it's been a massive move already over the last 5 weeks.
Brilliant. We didn't talk about this, and folks, the conversations, Kelsey Barrow that we had yesterday, Peter Cheer, Priya Misra this morning, and Priya talked about the migration. Lisa, this is your world, migrating out from full faith and credit treasuries, and the bad things that happen there end up migrating out into credit and then into distress.
Well, this is the key issue, right? We don't understand what it means for a company that grew up in zero rate eras to suddenly have to refinance at a 9% era for a high-yield company at a 10% rate. And at what point does this become a fundamental concern that threatens the viability of some of these companies?
That's not a zero coupon bond, John. That's a zombie coupon
It's
bond.
the knives and forks on the plates that I don't like at the Economic Club in New York. As the conversation's going, why can't they eat before the talk? Why do they have to eat during the talk?
Full disclosure, folks, and I
It
sometimes
makes it so hard to listen to. It's usually you with the knives and forks on the plates.
No, the tradition on the podium is we don't eat until after the speaking and the Q&A. And I go in there starving because they've been up since 3 a.m. and I want to hit the rubber chicken like nobody on this
like
stage.
nobody's business.
Get out of my way.
Well,
Are we here? Let's do a data check.
I thought Lisa was going to say something.
I thought she was
Okay, well,
right.
I'll just say this, that
Okay.
actually they put the salad out first, and then they serve the meal afterwards. So they actually are trying to cater to some of those concerns.
The salad.
Yes.
That's, okay. Equities on the S&P. We'll get back on track. Positive by 0.1% on the S&P 500. Yields here, TK, up a couple of basis points. 473.81. The jobs report.
Yeah.
25 minutes away.
Well, that's where the yield is right now. I'm going to look at the VIX, 18.63, and the equity market really like, okay, what's happened? Not much. Boy, do you not see that away from equities. Briefing us is always, we start strong in this Jobs Day hour with Nadia Lovell, Senior U.S. Equity Strategist, UBS Global Wealth Management. Nadia, I talk about the VIX at an 1819 level. How are equities ignoring the bond carnage?
I don't think equities are ignoring it. I mean, you're seeing valuation adjust to all of that. You've seen the market pull back from its high down 8 or 9% from the late July high. And so, but we do think that this pullback is healthy. Also, I think what's happening in the market is that we've sort of been in this micro news air pocket, if you will, ahead of the earnings season. And so the earnings season should be able to provide some clarity on the outlook for corporate earnings. We do think that corporate earnings will start to inflect back up in the third quarter, and we should be able to see growth. So that could be actually a potential catalyst for the market.
Are we in a bull market, or with this difficulty, this emotion of the last month, have we reaffirmed some form of bear market trend?
We think that we're still in this bull market trend. I mean, the earnings, again, should start to re-accelerate. And reality is, like, it's normal to have a pullback. We're not even at, like, a 10% correction yet. And so I think that we've gotten used to, at least this year, driven by the rally in tech of the market being on this steep upward trend. But a pullback is healthy. It does take a little bit of a valuation fraud out of some areas of the market. And so in our view, the risk reward is actually looking a little bit better for the equity markets from here.
So are you buying?
We are. We will be legging into this, weakness, continuing to dip our toes into it, but being selective in the areas of the market. You sort of want to maintain that balance. And so we have a balance with some defensive exposure along with some cyclical exposure, as well as some exposures to some of the secular trends that are happening in the market.
Are tech stocks defensive or growth?
I would say I would put them in the middle, in terms of, like, yes, there are parts of tech that are quite defensive in terms of the software areas of tech where there's a high level of recurring revenue. So that's by some stability in the earnings. And of course, you have other parts of tech that are more cyclical in nature, whether it be semis or hardware. But we are also seeing some bottoming in trends there. So tech kind of, plays all different areas. But I think overall, how I would categorize the tech sector is high quality.
Well, the high quality there translates to free cash flow. And to me, at the end of the day, with all the uncertainty described by the bond market, Ellen Zentner of another house, Morgan Stanley, says there's great uncertainty here in 23 minutes. Okay, Nadia, all that's great. But the only thing I can hang my hat on is free cash flow. Do you agree with that? That we're really back to Graham, Dodd, and Cottle analysis?
I think it's important to look at free cash flow in this sort of environment, and also, strong balance sheet as well as part of that equation, especially when you're in an environment where rates are likely to remain higher for longer. You also want to make sure that those companies are able to self-fund themselves and not have to dip into capital markets.
Nadia, can you give me a target here on SPX, or are you going to wait for a Monday announcement on that?
No, for next year, I mean, we're looking at 4,700. So we do see upside to the market from here. I mean, of course, we'll see what the job reports are at 8:30. But reality is, I wish that we would get out of this sort of twilight zone where good news actually becomes good news again and bad news is bad news. I mean, the fact is that the economy does remain strong. The consumer remains strong. And so hopefully at some point the market will start to appreciate that. And I think that the earnings season could be that catalyst to do that.
Let's finish there. There is this question about how you trade around the jobs market. Some people don't want to. Some people say they don't, but do anyway. How would you, all things being equal, trade a good number? Is good news for you yet?
I think good news is good news at this point. I mean, in our view, we think the Fed is done hiking. I mean, as you've been talking about all morning, financial conditions have tightened significantly, at least in your interview with Daly yesterday. Obviously, the fact that we've had this move in the bond yields does account for sort of additional rate hikes. So we're in that Bostic camp where we think that monetary policy is significantly restrictive. And so we would look to be positive and good news being good news at this point.
Where do commodities fit into this? We were talking about the deal in the shale patch, Exxon coming out with the biggest deal that they've done in decades. How much do you lean in, even after how much of a bid up we've seen on the heels of some of the weakness that we've seen over the past couple of days?
Yeah, I mean, we are still constructive on the energy sector, and we actually think that this pullback in oil and energy does give investors who might have missed it an opportunity to really dip into this well again. I mean, OPEC Plus remains quite committed in constraining supply, and we know that demand picture remains very strong. So we continue to believe that oil prices, Brent, is going to be $95 and sustainable into next year. And, you know, that free cash flow that you were talking about, Tom, you know, it exists in the energy sector. Free cash flow is or 10% strong balance sheets and the likes.
Quickly here, Nadia, I love what you're saying. You know, I want to say good news is good news with you. But I got a 5.49% 3-month T-bill. I mean, I'm sorry, the siren call of money market funds in a short paper is a huge constraint still, isn't it?
It is, but we don't think that these levels of bond yields are sustainable. We do think that bond yields will trend lower from here. I mean, yes, a 10-year bond yield could remain in this 4 to 4.5% range, but the economic momentum that we've seen early in this year, we just don't think that will continue into the fourth quarter and into next year. So we are looking for the 10-year bond yield to come down towards 4% by the end of the year, and then trend towards 3.5% by the time we get to mid next year, as the Fed looks to cut rates.
So given what you expect, is the biggest risk for you a re-acceleration in the economy or a hard landing?
A hard landing is the biggest miss. Equity markets isn't really priced for that. I think most people are in that soft landing camp. And we also know when you do hit a hard landing, that has implications for earnings growth. Earnings tend to pull back, you know, in the mid-teens into that sort of scenario. And so we want to see the continued strength in the consumer. Inflation is coming down. We don't want a re-acceleration in inflation. So we sort of want that Goldilocks scenario to happen over the next 12 months. But, you know, time will tell and the data will determine.
It's what we always want, not too hot, not too cold. Just right, Nadia. Nadia Lovell, thank you, of UBS on this equity market. Appreciate it, as always. Counting you down to the payrolls report. Fantastic lineup for you. Randy Krosner, former Fed governor, joining us going into the number. We'll get some reaction from him at the other side as well. Jeff Rosenberg of BlackRock will give us his perspective too. Mohammed Al-Arian, I can tell you, with us here in New York City in the studio. He's going to catch up with us about 9 a.m. Eastern time to go into the opening bell and break all of this down. And then Secretary Sue, the Labour Secretary, or the nominated Labour Secretary.
I've lost track of that as well.
Hasn't been confirmed just yet.
Yeah, what was that, you know?
I know. Tom, we don't have a speaker either, officially.
Yeah, really.
Congress either, so, you know,
exactly.
Step at a time. If you're just tuning in, welcome to the programme. We are positive here by 0.1%. Counting you down to that payrolls report, let's call it 20 minutes away. Tom, the number we're looking for, 170K.
170K, and again, you go over the wage dynamic, which, John, you often do there, and to see if that's going to break. But, you know, maybe the worst outcome here is stasis, where we just get another middling report. Nobody's talking about that. We're getting drama here, drama to the right, drama to the left, and what's the damage to the bond market if it's just...
Was it B. Mosey and Lingen this week who said slightly negative? Was that him, Lisa? I think he said. Someone said this week, one of our guests this week said slightly negative.
It's the best case.
Would be the best outcome for everybody. Slightly negative,
not
too much on trends, slow down.
Yeah.
Just slows down the bond market sell-off a little bit. But it's good enough, it's decent, that you're not crying about a recession anytime soon.
For everybody to understand, Lisa can remember out about 1 week. I can remember out about 1 minute. Farrah's telling me things we did 4 months ago where he has a crystal clear memory of whatever it was. How do you do that?
I rewatch the program all the time.
My deepest sympathies.
And I take notes from the guests. I've always done that. Go through the transcripts. Done that forever.
Okay, I'm watching.
Which is why I remembered that Saudi America line that you used a long time ago.
How do you do that? I mean, I'm worried about F1 in Qatar this weekend and on Tots Luton. Is it Luton? Is that how you pronounce it?
Is that what you're going to watch?
Tots Luton. Got to watch.
Formula One back this weekend?
Formula One, I believe, is this weekend. Maybe next week.
I have to double check that. It's next week? All right, we'll get up to speed.
I'm rooting for Orioles Diamondbacks.
Isn't
That's
Vegas,
really what I
the
want to
Vegas
see.
race soon?
Yeah, Vegas race.
Okay, all right. Good to be up to date.
It's a sports report.
We'll do that in the break.
Names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose sides.
Bloomberg. Context changes everything.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at BloombergLive.com/screentime.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Where we've been wrong is the fact that normally I don't think deficits matter, but investors have been asked to take these bonds when there's a big inversion and there's loads of them. So if you can remove the inversion and change the data backdrop, then the valuation piece will come in as well. So I think slowly the conditions are getting better.
Steve Major of HSBC, just one of the best in fixed income, had a tough year, Tom. Bullish on fixed income. It's not worked out that way with the sell-off continuing, but certainly getting an understanding of where he went wrong. And I think the explanation around it is really, really important. Traditionally, deficits don't matter. In downturns, they really don't, because people will buy treasuries. The point he's making, I think, is really interesting. It's difficult to get people to go out the curve for less yield when the data is still good and you're getting tons of bond supply, which is the point Steve is making.
I think the flow issue here is critical, but it also percolating into this weekend. And you really wonder, we were saying people can't vision out to 2024 right now. I really wonder the fiscal impact of this bond carnage that we've had. I've certainly underestimated it. And, you look at the rates of change in the Chicago-like mathematics of what's going on. And to Steve's point, is it about the debt and the deficit?
Ramo's been asking for a real-time ticker of that, haven't you, Lisa?
I want that. I want to have an understanding of how much the interest payments are going up in real time as you get the 10-year yield climbing. And I know that sounds nuts, but at the same time, that's the reality of it. And if it sticks, the fact that the U.S. did not push out their maturities the same way that corporations and individuals did means they are sensitive to those moves in a much more meaningful way than anybody else in the market.
We've got a former Fed governor around the table who was just like, yes, I want that too. I want that too. He's going to join us in just a second. Let's get to the price action on the S&P 500, positive by 0.1%, about 13 minutes away, 12 minutes away now from the payrolls report. Yields a little bit higher by a couple of basis points, 473.60. What an ugly week crude is have. Could close down close to 10% lower on the week, down to 82 on WTI. Worst week, TK, going back to March.
This is our interview of this bond carnage. There's no question about it. I've said for years that out of Brown University, the gentleman from Chicago is our definitive financial economist, and that's saying something at Booth School with Lars Hansen, Austin Goolsbee, and Raghu Rajan darkening at the door. He's a former Fed governor. On this jobs day, we're going to rip up the script with Randall Krosner. I am so honored you are here with us today. I'm going to steal from Raghu the fault lines of Randall Krosner right now in this bond carnage linked into our greater economics. This is Boo School 101. Let's steal from Raghu and the fault lines of the great financial crisis. What are the fault lines you see right now in this bond carnage?
And so I think that's exactly the important thing to be focusing on is what are the unintended consequences of this? Because we know that interest rates are going up because people are concerned that the Fed's going to keep rates higher for longer. The markets finally seem to have gotten that message. Right. And I think Jay Powell's been pretty consistent on that for a very long time, but the markets are now focused on that. And we have to look at, well, what are the consequences of this? You know, we've seen around the world that when interest rates move up very rapidly, sometimes people who have been hedging properly or have been involved in a lot of leverage when they've been trying to hedge get into trouble. And so we're going to sort of see this over time. One of the manifestations, obviously, was Silicon Valley Bank earlier this year. Yeah, and that's a small bank. Let's talk about the big banks. We've had a constant message that everything's fine with the big banks. I don't buy it for a minute because I heard the same tune in July of 2007. On a tranche basis, everybody's focused, including the media, on the garbage of the tranches. I'm going to go with David Goldman, and I'm worried about price movement in the better quality, middle quality tranches. Do you people at Booth have a conviction that they will sustain and get through this carnage? So I only speak for myself. As you know, at University of Chicago, every person speaks for themselves. So I can't represent other people's views. But I think it's very interesting to look there because if you go back to the global financial crisis, it was exactly that it was when markets started to get worried about the top
tier stuff.
So the bottom quality, that had fallen out much earlier, but it wasn't until really the summer of 2007 that the top parts got in trouble.
I love catching up with former Fed officials, Randy, because they're no longer burdened by the shackles of responsibility.
The shackles.
They can just tell us what they think. Can you tell me what you think they're probably discussing on the committee after the sell-off we've seen in the Treasury market? How do those conversations go?
So you'll have different views around the table. You're going to have some people are going, finally, the markets understand what we're about, and they've got it, and that does our job for us to some extent, because the markets weren't believing them. The markets kept thinking, oh, well, you know, these guys, they say that they're going to hang tough, but you know, most people in the markets have only been there for 10, 20 years. And they don't realize that in the old days, the Fed really would hang tough. They've only seen what's happened really since the global financial crisis. But the traditional approach is that, you know, when the party really gets going, the Fed takes the punch bowl away. And they're willing to do that, and the markets are finally getting that. So I think that's the discussion. Are they getting it? And then the question is, are they getting it too much?
As a Fed governor, would you sit there in real time and dial up a colleague on a board of governors and have a conversation about what is developing? How does that work out?
So it's exactly that. So there would be things, issues that would come up, and we might have a small group meeting, or we might have just a one-on-one on what's going on. How do we understand this? Does this fit with our models, or is there something different here? Then we might have ask for a briefing from the staff about, gee, is there something new here? Should we be using alternative approaches? Most people ended up with the traditional approaches, but it was usually
Can you think of an occasion where things did really change for you, where you had to pick up the phone and say, this isn't right?
Oh, certainly in the starting in the probably August, September of 2008. That was really when things were not moving by the playbook, and we knew something was terribly wrong. It's like, we really got to work through this.
Do you feel like at this point you would change your view? If you were on the Fed, all things being equal, based on the pace of the move, do you agree with the Mary Daly view of things, that if yields do stay at this level, that will remove the need to raise rates again?
So there's the short run interest rate and the longer run interest rate. And obviously, we've been focusing more on the 10-year rate, which has moved up very dramatically because people have finally gotten the message that the Fed's going to keep interest rates high for a while. I think it really would depend on how the data evolve. I mean, we're going to get a very important number in just a few minutes. We're also going to get some more inflation numbers. And so you might want to move a little bit more if the economy continued to seem very strong, if the labor market continues to be strong, if we're getting a lot of wage pressure, because the 10-year rate does a lot, but it doesn't do everything.
This is a difficult time, isn't it? It's very uncertain, and all of the data points that people say matter so much are really pocked with a lot of uncertainty and revisions backwards that are perhaps not necessarily that accurate. So which data point is the most important? Which do you watch the most closely?
So I'd say, I'd go to two. One is the data points that we're going to be getting today, and the other are on inflation itself. And in particular, the core personal consumption expenditure index, not the CPI, because the CPI is too focused on housing. The PCE has a little bit less of the housing in it, a little bit more of sort of general services, and so that tends to tell you a little bit more about where inflation is going. So labor market and the inflation numbers.
You know, I talked to the president last night, and I said if Michael Barr has to step aside, Krosner would be perfect as a vice chairman for regulation. And I don't want to keep you busy here. Michael Barr's got to be worrying today through October about mark-to-market. Now, maybe it's a little bit away from your remit, but the answer is we've got this confidence, which Michael Spence has written about. OMG, we fixed it in 08, 09. We fixed mark-to-market. We have great transparency with our major banks. I don't buy it for a minute. Do you have confidence that the Fed has knowledge of the opaqueness between mark-to-market and the free-for-all of this bond market?
So they know there's an opacity there. Do they know the exact numbers? No one knows that. Precisely because...
Can they measure the opacity?
You can get a feeling for how much you don't know, but it's not like you can say, well, gee, we know that these are not being priced to market too quickly. You can't say, I know what that market price would be.
I got goosebumps. That was Grossman Stiglitz from a million years ago. What he said that's so important is you know what you don't know. That doesn't help you if your bond's moving from 82 down to 78.
We don't know the jobs report. We know that. It comes out in about 5 minutes. We'll find out what it is in just a moment. Mike McKee's standing by. He's going to break that down for you in just a moment. Off the other side of that, we're going to catch up with Jeff Rosenberg of BlackRock. In your equity market coming into all of this, on the S&P 500, we're positive by 0.1%. In the bond market, we look a little something like this in the Treasury market. Yields, Tom, higher this morning by about 3 basis points on a 10-year, 4.7485. Mike McKee, can you give us the tease for 5 minutes' time?
I think what we're going to see today is a bond market that's like a coiled spring for this. When you look at the whisper number, it's 189 right now, and the forecast is for 170. You noted that the 10-year yield is up about 3 basis points. Everything's kind of coiled to go higher if we get an upside surprise. And so that'll be the real story, not so much what the number is today, but how the bond market interprets it. We also expect the unemployment rate to go down a bit, so if that doesn't happen, there'll probably be some confusion for a few minutes till we figure out why, whether it was more people in the labor force or whether people are starting to get laid off. So it's going to be interesting to watch the reaction to this, even more so than the numbers themselves.
Mike, to steal from Randall Krosner of Boost School Chicago, you know what you don't know. What's your biggest mystery in this jobs report?
I don't know what I don't know, Tom. Actually, I think that one thing we don't know that could matter is the number of people who come into the labor force. It was over 700,000 last month, and that's what pushed the unemployment rate up. That's considered a good kind of move, but if we get a much smaller number, that could help the unemployment rate go back down again. We don't know what that number is going to be. Probably we have an interestingly wide range for the jobs report itself. Steve Stanley up there at 250,000. So that'll be something we don't know either. That'll be interesting to find out.
Randy, your final thought before we get this figure in terms of what you're looking for in the granular data, what you're trying to understand.
So really the key will come down to wage growth, because that's one of the key things that's, you know, if you think about what the costs of production are, even for manufacturing, wages are and labor costs are a very significant fraction of that. And of course, in services, it's almost everything. And so if you think about where are the cost drivers going to be going forward, it's in the labor market and in particular the wages that we'll be getting just in a few minutes.
What did you think of the forecast from the Fed a couple of weeks ago? Aspirational?
So as you know, people talk about hard, soft landing. Jay Powell's talking about soft-ish landing. I've been talking about hard-ish landing.
Hard-ish, what's that?
That means that I really think that we can't get out of this without a substantial slowdown, possibly recession, not off the cliff. But I really don't think we're going to get out of this without a substantial slowdown. And I didn't really see that as much in the data or in their forecasts as I would have been forecasting.
Randy, stick with us. We're going to break this down in a moment. TK, the estimate, as you know, well by now, 170,000.
Halloween 2009, a 10% unemployment rate. This jobs report is important is the angst we felt at 10%. Completely different. It's about finance and bonds, not about the real economy. But I got to go back to Halloween of 2009.
Elisa, what are you looking for? Headline number, 170, that's the estimate. Unemployment, looking for that to come down to about 3.7 from 3.8. Wage growth, average hourly earnings, month on month, looking for 0.3 up from 0.2.
Honestly, I'm watching the bond market and its response, to quote McKee. I mean, honestly, to me, that's going to be the most interesting thing. If we get an upside surprise, does it get revised downward next month? We shall see.
Well, let's go through the price action for you, how we're set up ahead of all of this. I've gone through the numbers that we're looking for. 170,000 is the median estimate in our survey. Let's start with equities on the S&P 500, positive here by 0.1%, heading potentially towards a fifth week of losses on the S&P 500. I've said it a few times already this morning, but the fate of this market today, very much to some extent, to a greater extent, in the hands of the data you'll see in about 20 seconds' time. In the bond market, yields look like this on a 2-year, a 10-year, a 30-year. Earlier in the week, a 30-year through 5% this morning, 490.34. Yields up on a 10-year maturity, up by a couple of basis points. New cycle highs earlier this week. The yield right now on a 10-year maturity in America, 473.81. With the labor market data, let's get to Mike McKee. Hey, Mike.
Good morning, guys. And the numbers are just coming out now. Unemployment unchanged at 3.8%. That's the first number we get this morning. Payrolls, though, wow, 336,000. Let me repeat that, 336,000. Change in private payrolls, 263,000. Remember, ADP said 89. The change in manufacturing payrolls up 17,000. And for the months of July and August, we've got a revision of plus 119,000. So the labor market considerably stronger than people thought. Average hourly earnings, Randy was worried about that, just up 0.2%. That's much lower than anticipated, same as last month, which pushes the average hourly earnings on a year-over-year basis to 4.2%. Labor force participation still at 62.8, so not a major concern there. And in terms of the establishment data, leisure and hospitality still the leader, 96,000 jobs during the month. Government employment increased by 73,000. Now, there were questions about the seasonal adjustment for teachers in August, and so that may be a bit of a payback there. And I'll have to look up, well, here we go, transportation and warehousing up 9,000, truck transportation adding 9,000 jobs. Remember, we lost 37,000 in August when Yellow went out of business. Looks like about 9,000 of those reabsorbed. I'll go through this. You guys check out what the bond market is doing, because this is sort of the mother of all upside surprises.
I don't need to check, Mike. You can already guess. Mike, thank you. The sell-off resumes. Slow down. What slowed down? Major upside surprise on the headline number. This is a knee-jerk reaction. It always is. Let's see if it sticks, but I'll give you the price action right now. Equities down hard by about 0.7% on the S&P 500. Let's slice and dice the bond market for you. 2-year, 10-year, 30-year, 2-year up by 6 or 7 basis points to just short of 5.1%. 10-year high by 7 basis points to 4.79. 30-year had a look at 5% earlier this week. We're heading back towards it, up about 6 basis points right now to 4.95. Once you've guessed where the bond market's going, you can assume where foreign exchange is. The euro breaking down against the dollar, just about holding on to 105. 105.20 on the euro against the dollar. TK were negative by 1/3 of 1%. I'm going to say it, Tom. It's early days. I know it can change, but good news was just bad news maybe for this market, Tom, at least for now.
I'm not going to insult Randy Krosner with the good news, bad news silliness. What I'm going to look at is a 2 standard deviation move up in the inflation-adjusted rate. And John, I just can't say this enough. I go to a real rate analysis. We'll do that with our great team of people. Commercial free for you in the next 28 minutes. Michael McKee takes a second look at the impossibility of 18 pages of data. Mike, what do you see?
Well, I'm looking through where we found jobs. Construction's still adding 11,000 during the month, so the builders are still putting homes in the ground, and they're still looking to find people. The manufacturing jobs I mentioned earlier, 17,000. There have been questions about what would happen, but the ISM number earlier this week suggested we would see an increase, and we do. Retail adds 19,700. I don't need to do the point there. And professional and business services adds 21,000. That was a big category of gain in some of the earlier numbers this week. So it's interesting that we see that follow through. It's an area where if you're adding jobs, it's a suggestion that maybe companies are still looking for more. So it looks at this point like the overall number is solid, and it comes from a lot of different categories, not just hiring in one or the other.
If you were hoping to get away for the weekend, stick around. I guess you've got no choice now. Stick around for the next hour on Bloomberg TV as well. Coming up at the Open, Bloomberg's opinion columnist, Mohammed Al-Erin, and president of Queen's College, Cambridge, Mike Collins of PGIM Fixed Income, Victoria Fernandez of Crossmark, plus reaction from the administration in Washington at 9:45 Eastern Time. We'll hear from the acting U.S. Labor Secretary, Judy Su. TK, this market down by about 1% on the S&P.
Let me do a data check here as we get to Governor Krosner here in a moment, and that is I'm going to give you a 5% 30-year bond in moments, 4.99% right now, 10-year. We've got a new initiative here to a higher yield, lower price as people consider Michael McKee saying that this job report was across many, many different sectors. It was not a dysfunction or singular or that. Randy Krosner with the Booth School, Chicago. Randy, I'm going to go from a nominal to a real rate analysis. Let's go back to first principles. I never framed a 2.50 10-year real yield. Why does the real yield matter, and how will that new high real yield change our listeners' and viewers' lives?
Because ultimately it is the inflation-adjusted rate. It's the real rate, you said, that matters for thinking about what investments firms are going to be willing to make. Because if prices are going up and they can input prices are going up, that's one thing. But if you adjust for the inflation, so you take out that that changes in cost and changes in prices on both sides, you've got the real yield. And if that's going up very significantly, that means that firms are going to be less willing to invest. Are they less willing to hire? We've also started to see real wages grow, which is great for workers, but that's probably at some point going to mean a little bit less demand. Obviously not right now.
Well, that's where I wanted to go. What's your reaction as a former Fed governor to this report that is not only a massive upside surprise, almost twice as much as what the expectation was, but also with an upside revision to the prior month? What would you, if you were still on the Fed, do with this?
So I think look at two pieces. One, obviously, the incredible strength of the labor market continuing to be there, but the silver lining is that we didn't see a lot of kick up in wages. So I'd want to get into that in a little bit more detail, because that's really ultimately what is going to affect costs and what's going to drive inflation. Maybe I was being too harsh in saying there'd be a hardish landing. Maybe we've got something that's perfect Goldilocks. I find it hard to believe. It's possible. After being at the Fed during the global financial crisis, I never say never about anything. But we've never seen something so perfectly Goldilocks before. But if you can have a strong labor market, but not have real wage growth being too high, that would be ideal for the Fed.
One thing that I'm seeing is the underemployment rate coming in a little bit, 7% from 7.1%. It goes to the Priya-Misra question, which would lead to a higher neutral rate longer term if we get an increase in productivity, if we see some sort of just general growth that means a higher inflation, higher growth kind of era. Are you hearing anything, seeing anything in this data that suggests that has a greater likelihood than you previously thought imaginable?
Well, not in the data today, but we have been seeing some pretty good numbers related to productivity growth. And ultimately, that's what we want to see. Higher productivity growth is great for economic growth and great for real wage increases for workers. Now, whether that's just sort of a one-off thing, it's going to take a lot more data to figure that out.
Tell me at the Booth School, is you people own the high ground on the analysis of our finance and to say one emotional thing, commercial real estate. The fact is, in the carnage that we're in right now, 30-year bond, 4.98%, we're going to have a normal American failure of restructuring, failure of businesses, new fresh money will come in and, at a lower distress price than that. Will we just survive this event, or can there be lasting damage here like there was in 07, 08, 09?
So I think we really need to rethink the business model of how this is financed, because a lot of small and medium-sized banks have a lot of exposure in this area. You know, the chickens are going to come home to roost because interest rates are a lot higher, so refinancing rates will be higher. There are a lot fewer people going into the office, so a lot of the commercial real estate values are going down. And I think a lot of the small and medium-sized banks are going to be stepping away from this. So the question is going to be, who will be financing this going forward? The big banks don't seem to have any appetite to do that. Maybe it'll be new players like private credit coming in, but that's very new. We will have to see.
But the heart of the matter here, Professor Krosner, is for the fossils like me, the collective memory of our youth of continental Illinois, out of nowhere. What are the shadows right now that you see of a continental Illinois, of portfolio insurance in 87, the leverage of 98? What's the Krosner shadow right now you're most focused on?
So I do think trying to understand what's going on with commercial real estate, how that's going to affect small and medium-sized banks is very important. And then also looking through, well, trying to look through into the areas we don't know about. This gets back to what we were talking about before, into the non-bank financial sector. So we've got a lot of data about banks.
Right.
But just as I was describing, there are a lot of non-banks who are doing traditional bank functions. We don't have as much insight into that. So that's something that we know we don't know, and we have to find out a lot more information
That's
about
another one-hour conversation with Professor Krosner. We'll do that at another time. We are honored you're with us today. For all of us at Bloomberg, thank you so much. Randall Krosner of the Booth School, Chicago. We're also honored that Jeffrey Rosenberg could dart in the door. He was just looking at his Bloomberg terminal. Jeff Rosenberg, let's take this all-in non-farm payrolls. I have the number here, 455,000 with revision. Take that shock into your shock of working at BlackRock this week in fixed income. How do you dovetail the two?
Well, you know, I think I'm gonna talk about something that we usually don't talk about on Payroll Friday, and that's third quarter earnings, which begin to kick off. And what this payroll report really, I think, starts to reconcile is a disconnect that we've been hearing between kind of the bond market consensus, soft landing, inflation, slowing labor markets, and at the same time, a very positive corporate profits, margins holding up. And here's the problem with those two stories is that how do you get the slowing in labor? How do you get layoffs if corporations are doing just fine with pass-through and with margins? And so the reconciliation of those two inconsistencies is on display right now. This is a much stronger labor market. Clearly, that's what we see in the report today across the board. And so the challenge is, and what you were relating to with Randy Krosner, is that this is an environment where rates are going to have to stay higher for longer, potentially even go higher. And the longer that occurs, the more those cracks and that vulnerability has time to eventually show up. But this is really telling you something that the equity markets have been telling you, that it's good for corporations, good profit margins, good earnings, isn't a good story for labor market normalization and for the inflation story.
Jeff Rosenberg, Mr. Fink's office called me this morning as I was coming in, and they said, don't ask Jeff Rosenberg anything about inside baseball at BlackRock. I will not. But I will ask you about the functioning of our fixed income market off this shock report. Are there instabilities visible outside of BlackRock that you see? Can we get transactions done as we get ever higher yields?
You know, it's been a remarkably orderly move higher in terms of market functioning.
Agreed.
In terms of liquidity. I think the issue that you, again, just went through with Randy about where are the cracks, where are the vulnerabilities, and Randy highlighted, you know, the change in intermediation. The financial system is much more disintermediated today, and in different ways that we haven't seen before. And so the story and the history is that as you have these shocks in terms of interest rates, there are vulnerabilities. The challenge is this time will be different in terms of where those vulnerabilities show up, and that will be surprising. I think the key here is that coming off of over a decade of zero interest rates, we established a lot of expectation for the persistence of low interest rates. And yes, there's a lot of liquidity still left over, private credit, dry powder. The issue isn't the liquidity, it's now the cost of that liquidity and whether or not you can afford those much higher higher interest rates. I think the thing to be aware of, however, is that in the private credit market environment, you don't have the same kind of liquidity triggers that you have in the banking sector. You mentioned continental Illinois. You don't have deposit runs. So you have a lot more flexibility to extend the time period, a lot more flexibility to limit any kind of spillover shock risk. So it functions in a different way, but it doesn't mean that there isn't still eventually the cost to be paid for a much higher interest rate environment.
Right now, as you talk, we are seeing the markets break down in a pretty significant way. We're seeing that 30-year yield climb back up toward that 5% mark, 4.98%. You could see 10-year yields climbing back up near the highs that we saw earlier in the week.
10 basis point move.
Yeah, really just a moonshot, 4.82%. It's coming in, it's going up. It's definitely a volatile morning. The euro going down to 1.051. So you could see it just flirting with that 105 level. Jeff Rosenberg of BlackRock, I am curious from your vantage point why you would buy bonds here if you see this kind of strength in the labor market persisting.
Well, I think when you say why would you buy bonds, I think one of the key things about the fixed income markets is there's a very different level of opportunity set across the yield curve. And so the front end of the yield curve is really pricing in a lot of the forward path. The movement today basically pricing in now 100% of the final increase in interest rates. You know, if inflation and the kind of one silver lining in today's report is average hourly earnings, you know, if that picture still maintains, then the Fed can hold rates at high levels, but doesn't necessarily have to go further. That's already in the price. And when you look at the back end of the curve, yes, there's more vulnerability. Yes, we still think there's more term premium steepening to go, but you're starting now just finally to get to levels where you're getting back to normal. And that movement from abnormal to normal is very painful, but where you're getting closer, and that's interest rates that approximate nominal GDP. That's the history of where the long-term interest rate should be, and you're getting closer to that. You may overshoot, and you may have more term premium risk because of the deficits and QT, so we're a little bit cautious on the back end, but why would you buy bonds? You may not want to buy bonds like 30-year bonds, but the front end of the curve is really starting to get to levels that are much more attractive.
For 2007 and on, this is one of the historic days we've had on Bloomberg Surveillance. We welcome all of you commercial-free here through the hour. Michael McKee with us, Jeffrey Rosenberg of BlackRock, Ira Jersey scheduled to be with us as well. On the data check front, equity markets somewhat quiescent. We're out a stick on the VIX, 19.46, and basically a 1% move in the Dow. The NASDAQ, SPX does fractionally better. SPX is down 0.8% as well. I can't say enough about the moves in the bond market. If I keep talking, Lisa, we're going to get a 5% print on a 30-year bond. I can round it up right now. We need to get a reassessment of this historic jobs report, 455,000 with revisions. Michael McKee with one more insight.
Well, it's a fascinating number, Tom, because nobody expected it that high. Steve Stanley was by far the highest on Wall Street at 250,000. So it does show that people are still looking for workers. Now, the question is, when you have a number like this, how much of a drop-off are you going to get the next month? Or are we going to keep this sort of thing going? Some of this may be payback for numbers that were a little odd last time, like the yellow trucking went out of business and subtracted 37,000 jobs, 9,000 came back, so we don't get that effect again. And there obviously was a seasonal adjustment issue with education because we got 40,000 additional folks in education during the month. But it's still a very, very strong number. Now, the interesting thing I take away from this is that with the 10-year note yield headed to wherever Tom drives it, does this mean that the strong number pushes Wall Street to reprice for yet another Fed move, or is this the Fed move? When you go back to Mary Daly yesterday saying that the market yields rising had the equivalent effect of another 25 basis point increase. Does this mean the Fed has to move or not? And I think a lot of that probably comes down to next week, the CPI numbers that we get. If the inflation rate is still going down and we didn't see a big wage increase here, then it's okay to have this kind of job growth.
Right now, definitely the bond market is speaking, and they are doing a lot of work in terms of tightening financial conditions. I'm also watching the euro breaking down below 105 now, 104.99. Jeff Rosenberg of BlackRock still with us, and from your vantage point, is this the one hedge that has worked in this period of turmoil? Buy the dollar.
Yeah, it's been pretty much rate driven, and I think as you're highlighting this morning, that rate move is reflective of the move in the dollar is reflective of that rate move. I want to go back to what Mike McKee was just saying in terms of the Fed, and I think that is what you're seeing in terms of pricing in the last hike. And I think also as well, they will recognize that the market is doing a lot of the work for them, and we're going to get the tightening in financial conditions, and they were hoping to avoid an easing of financial conditions, which is what they've gotten here. So I think that helps to kind of move us off of the Fed tightening path. The real issue in terms of the bond market pricing into next year is we've priced out about half after the FOMC, half of the cuts that were priced into next year. And I think that's the next move that you can start to see, is really pricing out the cuts as you get more of this higher restrictive for longer kind of perspective.
And we did see that 30-year Treasury yield across that 5% mark just briefly, but flirting once again with that level. Jeff, how much is this a sustainable rate? You said pricing out cuts going beyond 2024. Is this sustainable economically and from a risk asset perspective?
Well, a lot of that depends on this projection in terms of the inflation trajectory, right? So the reason for the cuts priced in, or one of the reasons for the cuts priced in by the bond market, is the expectation that inflation starts to fall, and the Fed wants to cut rates so that, you were talking about it earlier, Tom, not having real rates go up as inflation goes down. So is it sustainable? Yes, but a lot of that's going to go, and Mike McKee, you hit it on the head, next week in the CPI report. It's a very strong jobs report. A big component of the inflation expectations declining is that core services ex housing, which is really related to the jobs market. So good news here so far is AHE, average hourly earnings, not ticking up. As long as you see that inflation trajectory go down, then I think you can get that pricing in the second half of next year.
Jeff Rosenberg,
it's very much dependent on that inflation.
Jeff, I want to go to you with one more important question. Stay with us, and we're going to bring in Ira Jersey right now, Bloomberg Intelligence. Moments ago, folks, we have a 30-year bond of 5.01%. Lisa will tell you what the bank rate 30-year mortgage is going to set at on Monday. Who knows? So we have Ira Jersey and Jeffrey Rosenberg to get us to the next hour. Dr. Alarian will join Mr. Farrow here in the hour. I'm thrilled to tell you Paul Sankey will join us on Exxon Pioneer on Bloomberg Radio here in a bit. Jeff Rosenberg, I want to cut to the chase. I've got a multi-standard deviation move in price in a blended bond index like the Bloomberg Total Return Index from the peak of the market in January in 2021. How do you frame out, Jeff Rosenberg, that institutions, retail, and retired America will somehow get back to the pricing of the Great Moderation? You must be looking at in years.
Yeah, and I'm not sure, Tom, the framing is that we're getting back to the pricing of the Great Moderation. And I think that's part of the adjustment here, is that you may not have that bond market that you were used to in terms of an upwardly sloped yield curve, falling interest rates, a high positive total return, and most importantly, a reliable ballast to your stocks. It's a very different bond market, and this is the transition period, and I think investors have to really recognize that. And so the opportunities are really changing how you hold your bonds in your portfolio. It's much more in the front end. It's much more about flight to quality. Insurance is no longer the 30-year. It's the front end of the curve. It's a steepening when you have a crisis because you've got that rate possibility priced back into the curve. So a lot of changes in thinking about how we build portfolios.
Jeff Rosenberg, thank you so much for taking the time on a day that truly is historic, as Tom was saying. Just looking at the 30-year yield right now, we are seeing on an intraday level the highest rates going back to August of 2007, solidly through 5%, 5.02%. Ira Jersey, Chief U.S. Interest Rate Strategist of Bloomberg Intelligence, joining us. And I've got to say, what a moment. Is this being driven by sellers or by a complete lack of buyers who have no conviction at a time when the U.S. economy seems to be running hot?
Well, today has to be sellers, just because you wouldn't expect a lack of buying to generate a 10 basis point move in the long end of the yield curve. I agree with a lot of what Jeffrey said. I think the The thing that we have to think about here is who's going to be the incremental buyer going forward. And when you have the global rate environment changing so significantly with positive yields in jurisdictions like Germany and Japan that had more than a decade of negative interest rates, now there's alternatives to just people buying treasuries. So I do think that we have shifted the demand dynamics and we need more domestic involvement. And we've seen that over the last year, but that's also come with yields rising pretty significantly.
I gotta say, Ira, I'm looking at something close to a 20 basis point move in a 10-year yield as it pushes up toward 4.9%. Is this healthy? Is this okay?
Well, liquidity in the bond market has gone down very significantly as you have new regulatory environment that's changed the way that the bond market trades on a day-to-day basis. So I think when you get moves that seem pretty large like this, one, are they fundamentally driven? The answer to today's move, I think, is yes. But then they just get pushed out even further than you would expect on if liquidity was decent. You don't have the leverage in the system you used to have, so you don't have levered investors who might say, hey, I'll take a punt, and if we sell off 20 basis points, I'll try to clip 5 basis points going the other way when the market gets oversold. You don't have those people anymore.
Yeah, Ira Jersey, you have so much perspective on this. Just thrilled to have you. And folks, I can't tell you enough about our team putting together Krosner, then Rosenberg, and now Ira Jersey. The market's walking away, Ira Jersey. There's no other way to put it. While you're talking, we're out to a 503, even 504 10-year. I've got a 30-year, rather. I've got a 10-year yield back to the summer, pre-August, third week of August of 2007. And if I look away and have some tang, I got the 10-year real yield out to 2.56%. Ira Jersey, you and I know, as Chris Whalen talks about, there's a point where there isn't somebody on the other side of the phone. Price down, you need to get rid of it, and you can't sell it. Are we anywhere near that analog?
Well, I think we're close depending on who you're talking about. And, I think your real yield point, Tom, is really interesting because with TIPS yields heading back, it seems, toward maybe 3%, at some point there's going to be value seekers in the markets. And we're just not quite at that kind of level yet, particularly with the repricing of how long the Federal Reserve is going to maintain rates at the peak. November almost doesn't matter. Even if the Fed hikes in November or doesn't hike in November, it's really, do they not then cut until 2025 or maybe even 2026?
Right.
So that's been one of the keys, I think, for the market here in the adjustment is, does it make sense to buy a 10-year yield when you can buy a 2-year note or a one-year T-bill well above 5%, and you think that you're going to be able to get that for the next 18 months. So it doesn't make sense to buy the long end if you get a better risk-adjusted return in the front end.
To the idea of the never of this October, Lisa, he just said it. I've never framed a 3% real yield. That was something from another, I don't think I had gray hair. It's from another time and place. What Mr. Jersey just said there, a 3% real yield. You tell me how Business America operates.
They are going to have to grapple with that. We're looking at right now close to 2.6% in terms of a real yield on a 10-year. So it's really moving in real time. Ira, I want to go back to something that Priya Misra said earlier in the show, talking about how banks are one of the biggest buyers that have stepped back, that basically are no longer hoovering up U.S. government debt. How much is this one of the main features, aside from China, aside from Japan, that really is one of the big drivers at a time when they used to reliably be a base for the U.S. government?
Well, so really, banks are not massive holders of all of the outstanding Treasury securities in the country, but they are one of the incremental buyers, right? So banks will step in, and they have a choice of whether or not to make a loan or buy mortgage-backed securities or buy Treasuries. And owning some Treasuries is something that they have to do now because of the regulatory changes that went in about a decade ago. So banks are always going to be regular buyers. I think that at this point, the banks have alternatives to what they, how they can manage their portfolios and manage their regulatory risk. So they can own a lot of reserves, right? So the Federal Reserve has kind of created this dynamic where banks don't need to buy as many treasuries yet because of the what's going on with their reserve balances.
Ira, a busy day of publishing for you and Bloomberg Intelligence. Thank you so much. Ian Ling, BMO Capital Markets, looking for 5% 10-year yields on the horizon, and does speak to the instabilities it will bring to the real economy. Our instability is to ask one final question of Michael McKee, who actually knows what he's talking about.
Oh, I wish I did, because somebody asked me, why did economists get this wrong? I said, I don't have a good answer right now. I'll have to look into that. We've just underestimated all along the strength of the U.S. economy. And when I say we, I'm including the Fed in that. And so it does change the game a little bit if we continue to see this kind of strength. 266,000 average each month for the past 3 months. That is not an economy that is going into recession. Takes that off the table. But the good news is average hourly earnings did not rise very much. So if CPI comes in soft, then how do you position the bonds?
Our final guest for the morning is Lisa Abramowitz, because this is her wheelhouse. The heart of the matter of Lincoln's Note, of Rosenberg, of Jersey, of Krosner is your world. How do we move from a full faith and credit analysis out into credit, into stress? What do you think will be the ramifications?
What we already have seen is the worst period of time, the worst sell-off in credit going back to March, when everybody was worried about a banking system collapse. At this point, this is where we start to see people worry about refinancing risk 1 year out, 2 years out for some of these high-yield companies. When does this become a sort of self-killing cycle where these yields have to come down because something breaks? I don't know the answer, and I don't think anybody does.
An historic moment for the financial markets. Please stay with Bloomberg Television and Bloomberg Radio through this morning. El Arian with John Farrow next.
Well, apparently good news is bad news, and really, really good news is really, really bad news. Live from New York City this morning. Good morning for our audience worldwide. Yields absolutely surging. Equities taking a dive. We're down by more than 1% on the NASDAQ. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, coming up, the jobs report delivers a major upside surprise. Detroit's Big Three bracing for a UAW update, and Exxon closing in on its biggest deal since '99. We begin with the big issue, payrolls in America.
Look at what's happening with labor. Today's data on jobs.
Non-farm payrolls. You do need to fold that into some of the other data we've seen.
That consumer and that labor market is something that we are very focused on. Our economy is really being well supported by two things.
The very tight labor market.
Resilience within the labor market.
And the consumer.
Consumers are still out there spending away.
Until that stops, I think we're in higher for longer.
The Fed wants the labor market to slow.
This slowdown is coming with the economy.
Only do you see the yields start to come down once you see visible signs of economic slowdown.
We will be watching, though, the unemployment rate and labor force indicators beyond just the payrolls print.
It's all about the consumer, and it's all about the labor market.
It's all about the labor market right now. With us to break it down, Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, let's get straight to it. Your thoughts on that one from 31 minutes ago?
I had three reactions, John, two of which you covered in your introduction. One, this is good news for the economy right now. The fact that we can deliver over 400,000 jobs, if you include revisions, without earnings pressure is good news. It is, secondly, bad news for markets and for the Fed. The Fed is not going to welcome this report, which leads to my third issue, which is over the long term, this may end up being bad news for the economy as well.
Well, let's break that down piece by piece and jump to the Fed piece of it. From your perspective, Mohammed, as you look at the move in treasuries this morning, and let's break it down together, 2-year yield higher by more than 10 basis points, 10-year up another 15 basis points, and briefly at cycle highs, fresh cycle highs just moments ago. Is that the market doing the Fed's work for it, or are you expecting more from the Fed because of these numbers?
So if this were not a data-dependent Fed, and how often have we heard this, we are data-dependent, which is always strange to me, because you are acting with tools that have an impact with a lag. But given how often they've said this is a data-dependent Fed, yes, it puts back on the table a hike for the 1st of November, which means that market now are not just having to internalize high for long, but higher for longer. And that is the problem. When you fall behind right at the beginning of an inflation cycle, you pay the price when you get to the last mile. And that's what we're doing right now.
A three-part story for you then, Mohammed. First of all, the data's good for the economy. Secondly, it's bad for the market, but ultimately that could be bad for the economy further down the road. You wrote for the FT earlier this week, the US may no longer avoid recession. How do these numbers play into a call like that?
Unfortunately, they are consistent with that call. Look, John, this is an economy that got used to ridiculously low interest rates and got used to liquidity injection. The change in the regime is happening really fast. So something is likely to break, probably in the financial markets, but that will have spillback into the economy. Then there's a second issue, which is just as important. This economy has to deal with a whole host of other things, the most important of which being that it is the supply side that's the problem, not the demand side. And unfortunately, that realization is not fully yet comprehended by the policymakers and by the markets.
So Jason Furman weighing in this morning and on Twitter. I've shared that view with you all. First reaction to jobs numbers, shock. Second reaction, nervousness. Further reflection, this could be quite good. Went on to say 336,000 jobs, participation's high, wage growth's moderated. We could be in the middle of a sustainable increase in labour supply. That's the hope and the dream, Mohammed. Is that the reality?
So Jason is right. I mean, if we didn't have the financial markets and if we didn't have a data-dependent Fed, then Jason would be absolutely right. The concern is the spillback from the financial markets and policy onto the economy. This on its own is really good news and will be welcomed by the White House. It will not be welcomed by the Fed.
It's not welcomed by the market right now. Equity futures down by 0.9% on the S&P. The jobs data looking really strong. I think we've all forgotten about that ADP report a little bit earlier this week. Yields up at the front end, up at the long end. On a 30-year, earlier this week, briefly through 5%, back through it right now. The 30-year, 5.02%, yields higher by 13 basis points and change. Mike McKee breaking down this jobs report. Mike McKee, I think you and I both just said wow when that one dropped.
Absolutely. I think the word that you'd use over in London is gobsmacked by this number. It really was a shocker. Nobody had anything close to this in the Bloomberg Economic Survey, and nor did the people on Wall Street trading desks. 336,000 jobs created, and then add in 119,000 revisions higher to July and August. The unemployment rate stays the same at 3.8%. Nothing really remarkable there. More people got jobs than lost jobs, but the labor market only grew by 90,000 during the month, unlike 700,000 the month before. The jobs numbers, the best part of it here is the average hourly earnings, just 0.2%, up 4.2% on the year. And the interesting thing about that is that this was a longer period of time, which is why some analysts thought we would get a high compensation number because more people would have gotten jobs during that period at higher rates. We didn't see that. Service industries, 234,000 jobs. And the interesting thing there, wages up only 1.7%. Leisure and hospitality continues its run, 96,000. Public education, this could be a seasonal adjustment problem with August numbers, up 40,000. And I threw trucking in there because we lost 37,000 jobs last month because of the Yellow company going out of business. 9,000 of them absorbed back. So a turnaround there that helps boost the numbers overall. Here's the good news for the Fed. The payrolls numbers go up so dramatically, and yet we see a decline in average hourly earnings on a year-over-year basis. To my mind, guys, this makes next Thursday's CPI report even more important because I'm not sure the Fed will look at this badly if the CPI continues to decline because the Fed doesn't necessarily want to see employment go bad. They just want inflation to come down.
So, Mike, is it possible to bring inflation down with such a hot labor market?
It's possible, depending on whether we see people spend more than they normally do. Spending's come down to about the point we were at pre-pandemic. The savings is gone. People are spending out of their salaries. So it is possible you can get back into alignment. And we've seen supply come into better balance. Doesn't look like there's any kind of wage price spiral, though. So, yeah, it's possible. That's what the Fed's not going to know.
Keep digging, Mike. Keep digging. We're trying to work through this one. Mike McKee there breaking down the jobs report. Let's keep digging into this bond market as well. Treasury curve steepening, selling off at the long end. So yields are higher on a 10-year, on a 30-year, relative to the price move today on a 2-year. The 2-year's up by 8 basis points. The 30-year is up by more than 12. So the curve is steeper. 2s out to 10s by about 5. 2s out to 30 by about 5 basis points also. Mohammed, let's talk about the character of that steepness. We thought if we were going to get a steepening of this yield curve, it would be driven by the front end. The jargon, of course, is the bull steepener. You get a rally at the front end, yields drop because you're pricing in a rate cutting cycle from the Fed, who has to confront a slowdown in the economy. We're not seeing that. In your experience, Mohammed, how rare is it to see a prolonged sell-off at the long end of the curve, to see the steepness come from a so-called bear steepener?
You had Priya Mishra on earlier today, and she summed it up very well. This is very unusual. But there's a reason why this is so unusual, and that's because the characterization of the economy has changed in my mind. What we're seeing here, John, is just a massive reaction to not rates going higher. That was last year. That was the understanding last year. Rates are going higher, but if you remember, there was a hope that was priced in that the Fed would be cutting pretty soon. This year is about high rates staying there for longer. And that is a fundamental change of how you think about the yield curve, and that's what we're seeing playing out in the markets.
One phrase I've heard, Mohammed, a few times this week is buyer's strike. Let's put some meat on those bones. Is this the investor basically saying, I'm not going out along the curve so long as it is inverted to take on a 10-year maturity for less yield when I'm seeing an expansion in economic data like that?
Yeah, and I also think, John, it's simply, I'm not going to catch a falling knife. That's what it is. I am going to wait on the sideline, see how things settle down. These moves are historic. They're absolutely historic. We're going to look back on this as, did we really move by that much every single day? And then the second thing to remember is that we don't know what the retail sector is going to do. There are very big losses right now in bond funds that are going to have to be somehow gotten used to. And then the last thing, John, I would say is, you know, a lot of people are saying the markets have functioned well. Yes, they have functioned well, but the extent of the moves suggests that there is something else going on. And people are asking the question right now, where is the pain? And today, the pain is going to be increased. So there's going to be a lot of people interested in seeing how the technicals evolve from here.
You and I have got a lot to talk about through the next hour. I'm pleased to say Mohammed's going to be sticking with us to break down some of the stuff we need to unpack, particularly at the end there. The prospect of things breaking, maybe even forced selling, with all that unrealized losses sitting on some books somewhere out there in the Treasury market. Equities lower by about 0.8% on the S&P, with some movers going into the open. Here's Abby.
John, let's keep it macro and on this hot jobs report and yield steepening in the way that you all were talking about and the re-steepening of the yield curve. Let's take a look at technology, because of course, as yields shoot higher, this makes valuation look less attractive. Microsoft down 1%, Tesla down 2.7%. Also weighing on Tesla, perhaps, are some of the Model 3 and Y price cuts here in the U.S. And then the banks not really getting a bid from yields going higher, or the re-steepening in the yield curve. You can see JP Morgan Chase, it's down 0.6% right now, John. The S&P 500 E-mini futures heading to a 5th down week in a row, the longest losing streak since May of 2022. So this idea of longer or higher for longer, it is certainly weighing on stocks.
Abby, there are some big moves out there, that's for sure. Abby's going to break them down for you in about 20 minutes' time around the opening bell. Coming up, much more on a monster upside surprise.
The incredible strength of the labor market continuing to be there. But the silver lining is that we didn't see a lot of kick up in wages. So I'd want to get into that in a little bit more detail, because that's really ultimately what is going to affect costs and what's going to drive inflation. Maybe I was being too harsh in saying there'd be a hardish landing. Maybe we've got something that's perfect Goldilocks.
Perfect Goldilocks? We'll question that next. The conversation continues with Mohammed Al-Erin, Victoria Fernandez, and PGIM's Michael Collins.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
From New York City,
From London and Sydney.
from Washington,
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
The president went to Michigan very recently, just last week, a week ago, actually, to show his support and to stand in solidarity with union workers. And that is, he did that because he believes that unions have the collective bargaining rights to ask for fair pay and fair benefits. He believes, as it relates to UAW, record profits should lead to a record contract. The president is always going to be proud of being the most pro-union president ever.
The labour market in America at the epicentre of conversations this morning. The White House pushing the president's pro-union agenda as the UAW strike continues. And if a deal isn't reached soon, the impact could be wide-ranging. A full strike involving all 150,000 UAW members could impact 760,000 jobs and show up in October's payroll report. September payrolls coming in much hotter than expected. Katie Lyons joins us now for more. Hey, Katie.
Hey, John, way hotter than expected. And that 336,000 print on payrolls for the month of September is certainly something that here in Washington, the Biden administration is going to be touting as a sign that Bidenomics is working. We'll hear more from President Biden later on this morning at 11:30 a.m. Eastern time. The difficulty, though, for President Biden is, on the one hand, yes, he wants and frankly needs a strong economy and labor market as he campaigns for re-election in 2024. But he also wants to be the most pro-union president in history, as he is often dubbed himself, and that is where potentially you could see things running into conflict. Our team here at Bloomberg Economics says a prolonged UAW strike, because of its secondary effects, could mean that every striking worker leads to the loss of 5 jobs in total. And when you add it all up, that is where the number of north of 700,000 layoffs comes from in the worst case scenario. And our team says if this strike lasts for 2 months, you could see 0.4 of a percentage point knocked off of fourth quarter GDP. We'll, of course, get more information as to whether or not the strike is expanding later today, 2 p.m. Eastern time, another Facebook Live from Sean Fain. And we know leading up to today's announcement, we have seen GM making a 6th contract offer to the UAW. Reportedly, it is a sign of progress, but not necessarily enough to stop the strike because it still comes up short of the latest offers from Stellantis and Ford. Ford, of course, made its 7th offer to the union this week, including pay raises of more than 20%, some sweetened contributions to the 401k as well. We'll see if any of it is enough to spare any of the big three, an escalation later today. John.
The longer this labour market stays hot, the more leverage they get, that's for sure. Kayleigh, thank you for the update. Joining us now to weigh in, PGIM's Mike Collins, Crossmark's Victoria Fernandez, still with us, Mohammed Al-Erin. Victoria, first to you. Your reaction, please, to a blowout headline number.
Yeah, Jonathan, it was a much higher number than we were expecting. We did think that we were going to continue to see growth in the job market. We know that we're not at the point where we're going to get a negative number. What we were really focusing on was average hourly earnings. You're just talking about all of the wage strikes, how that's going to feed into any kind of wage spiral that we see and what that means for the CPI report coming next week. We saw that go to around a 4.2% year over year. You combine that with a participation rate that didn't seem to go much higher. then I think that's where the elements are going to lie on how strong exactly is this labor market. You know, we had the JOLTS report earlier this week, and the one thing we have to look at is the quits rate is actually slowing. And I think some of that is because the wage difference that a lot of people were getting when they were changing jobs was up around 16, 17% higher. That's come down to single digits. So I think you're starting to see people level off a little bit in the rate of change for their jobs. We still obviously have a very strong labor market out there, and I think that's going to be difficult for the Federal Reserve. I know higher rates. Mary Daly was saying that that's like a rate hike, that takes the place of a rate hike. But when you have numbers this strong, and if we get a CPI number that does not show the level of disinflation that people are looking for, I think the Fed is back in the hot seat of needing to hike another 25 basis points.
Mike Collins, Francis Donald at Manulife this morning saying this: a soft landing negates the probability of a soft landing. A soft landing is not bullish for any asset class. Mike, what are your thoughts this morning?
Yeah, Jonathan, we've certainly been in, I don't know if I'd call it the soft landing camp, but, you know, a resilient economy camp, right? And you've seen it in so many ways, and this is certainly reflecting that. And we've also been in this, you know, higher for longer rate view, but I have to admit, I really didn't expect the extent of the job growth to continue. And maybe this is one number, maybe it's a flash in the pan, but the real surprise to me in the markets, and I think where maybe the markets are mispricing, is the extrapolation of the Fed's higher for longer narrative that has happened has reached pretty extreme levels, right? I mean, the markets are now pricing in. So bond geeks look at five-year interest rates, meaning what's priced into the market, what the market's crystal ball is telling us for the next 10 years. And right now, the markets are pricing in a Fed funds rate that only goes down to about 4.4% and stays there forever. And a 5-year treasury that only goes down to 4.80, meaning it barely moves from here and stays there for 10 years, right? And it's really hard for someone who's been in the bond market this long to really grasp the idea of a funds rate that's in the fours, the mid fours, for 10 years, right? At some point in the next 10 years, it's probably going to be lower than that. So that's really what's happened in the bond market, and it's really shocking.
So, Mike, I'm trying to understand where you're going with this. There's two possibilities. One is that the market simply is wrong, or two is that it's hard to reconcile the market's interpretation of higher for longer with your hope for soft landing. So which is it?
Yeah, the markets, these long-term forwards, Mohammed, as you know, they are wrong all the time, right? They overshoot, and investor behavior drives that, right? And what you've been talking about, Jonathan, this morning is the investor psychology out there, what they're thinking, and they're terrified of stepping in front of this rate sell-off. So they're all piling into cash. I've been speaking with a lot of investors over the last few weeks, and they are really hunkering down in the front end of the yield curve, holding on to cash. They've kind of given up on owning these longer term bonds, and people obviously are selling this morning. People are shorting treasuries through futures. So you do get these big kind of extreme moves, Mohammed, typically, in the deep parts of the recession and at the peaks in growth and at the peaks in Fed funds rate hike expectations. And it feels like we're kind of, bouncing around one of those peak periods and one of those extreme periods in terms of the permanence of what's priced into the market.
So, Victoria, if this migration to cash from both public equity markets and public fixed income markets continues, how does it impact your outlook?
Well, obviously, we want to see people be invested in the market fully. And even though we have had a negative outlook all year, we have been in that camp that said the soft landing probably wasn't going to be our outcome. We've actually been investing on some of the parts of the longer end of the curve for our clients. We don't want to just sit completely in cash or completely in a 3-month or a 6-month T-bill and have reinvestment risk coming. So the fear would be that if everyone is sitting in cash and they're waiting to try to time the market, they're either going to miss that, which is probably what's going to happen, or you're going to have a huge influx at one time and cause a lot of volatility. We would suggest, and what we're doing with our clients on the fixed income side, is you really need to barbell that. You need to have some exposure to cash or cash equivalents or short-term treasuries. But look, we're at a 490 on the 10-year Treasury. I'm not sure how much higher. Many people anticipate it will go. Technicals tell you maybe around a 5.10 or a 5.20. If you're buying individual bonds, you're buying at a discount right now, collecting your coupon, and you can hold that bond till maturity and receive par for it. So I think there's something to locking in these higher rates on the longer end while still having some flexibility and some liquidity on the short end, especially as we see liquidity coming out of the market. In the reverse repo market, we're seeing it with foreign treasury buyers going away. I think there's some liquidity components that we need to address as well.
Victoria, we'll talk about that. Mike Collins, Victoria Mohammed sticking with us. Your 10-year this morning, a cycle high briefly, 488, right now 482. Coming up the morning calls and later, Acting Labour Secretary Julie Su with the latest on the jobs report.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that because, you know, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
From the opening bell, equities trying to recover here. Let's get you some morning calls. Your first one from Oppenheimer, downgrading O'Reilly to market perform, expecting limited upside as pandemic-related tailwinds continue fading. Bernstein initiating coverage on Netflix with a market perform rating, seeing a mixed outlook due to mounting competition and slowing growth. And finally, Jefferies upgrading Elf Beauty to buy, seeing an attractive buying opportunity after recent declines. Coming up, the opening bell with more from Mohammed Al-Erin and Victoria Fernandez alongside Michael Collins, and later, Acting Labour Secretary Julie Su weighing in on the latest payrolls report. Your opening bell just around the corner.
The younger generations are more, of course, pay more attention to sustainability. And so they are looking at brands that are greener, but you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
To the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Seconds away from the opening bell this morning. Good morning to you all. We pull back on the S&P. Off session lows just on the Nasdaq. We're down by 0.8%. On the S&P 500, down by 0.6. 5 is not the magic number. We're heading towards a 5th week of losses on the S&P. Unless that changes. There's your opening bell. Switch to the board and get to the bond market. Heading towards a 5th week of yields climbing on a 10-year maturity. Your 10-year this morning higher by 12 basis points to 484. Yields up, dollar stronger, euro lower, 105.12. The euro poised for a 12th consecutive week of euro weakness against dollar strength. The dollar absolutely dominant in G10. That currency pair pulls back by 1/3 of 1%. And crude, look out below all week, heading towards the biggest weekly loss potentially going all the way back to March. Crude right now, positive by 0.6%, 82.83. About 30 seconds into the session, this looks better than it did about an hour ago. On the S&P, we're down about 0.5 of 1%. On the Nasdaq, down by about 0.7. One stock to watch at the open is Exxon, the energy giant in talks to acquire Pioneer Natural Resources, nearing its largest takeover since 1999. Citi saying the following: the logic of consolidation in the highly fragmented Permian shale remains compelling, with significant gains to be achieved. Abby has more. Hey, Abby.
Hey, John, and yes, this is a big one. So sources are saying that ExxonMobil is very close in advanced talks to acquire Pioneer Natural Resources. It could value Pioneer at $60 billion. Yesterday, Pioneer had been worth $50 billion. They, of course, are one of the premier producers from the Permian Basin, which is basically runs from parts of Texas and New Mexico. It's one of the most lucrative parts of the oil patch in the U.S. because it's much more easy to extract the oil. So what this would give Exxon essentially is, rather than buying a company where they would potentially have to develop unproven acreage, almost like a faucet where they can turn it on and off. So when oil is lower and volatile and it's been weighing a little bit, ExxonMobil into today had been down about 1%, and Pioneer into today down about 5% on the oil volatility, plus concerns that there could be a global slowdown and that would weigh on oil. But if there was a resurgence, they basically just have to bring out this oil. It's not quite as simple as that, but that's one way to look at it. Now, sources are saying that this deal could close in coming days, but it might not be super easy, John, because there could be some solid political and regulatory issues, scrutiny, given the fact that earlier this year in February, the White House did accuse Exxon of achieving what are called bumper profits at the expense of consumers. Stay tuned, but right now we do have Pioneer up about 8%, Exxon down 3%, suggesting that many do think that the deal could actually go through.
Stay tuned. Abby, thanks for that. Let's turn to the autos. GM presenting its 6th contract offer to the UAW, writing in an email that they're ready ready and willing to negotiate in good faith 24/7 to reach an agreement. This coming as Union President Sean Fain prepares to deliver an update on social media at 2 p.m. this afternoon. Simone Foxman on top of this story. Hey, Simone.
Hey, John. Yeah, all eyes are on that announcement, which will be Facebook Live, YouTube, etc. in this day 22 of the United Auto Workers strike. We could hear plans to expand the strike today. Right now, 25,000 United Auto Workers are striking of the 145,000 total population, and so far the strikes haven't impacted the plants that produce the full-size pickup trucks, the large SUVs that are the most profitable for these companies. So we're very much focused on where we see those potential strikes expand, because they could have more of a hit than we've currently seen on their bottom line. And we'll also be looking for whether or not the union is going to reward progress on some of the talks, including perhaps with GM, where it does seem both sides have made some progress a little bit on retirement benefits, even though GM very much focusing on strengthening 401ks. However, despite that announcement from GM that there was this offer submitted, we saw shares close at their lowest since September 2020. Ford has also been under pressure, really lowest since August. Stellantis is holding up better a little bit because of its global operations, and shares of all those companies are down, or Stellantis unchanged today.
Simone, thank you. More on this story with the Acting Labour Secretary, Julie Su. We'll cover this in about 10 minutes' time. Let's check out shares of Tesla right now. Tesla cutting prices on its top-selling models in the US again after Q3 deliveries fell short of estimates. CEO Elon Musk taking to X to challenge his critics, writing this: "Sometimes they question if I should even run Tesla. My response is simply, watch other CEO. Would you prefer?" Isabel Lee has more. Hey, Isabel.
Hey, John, lots of markdowns across the board. The company slashing the starting price of its base Model 3 by $1,250. It's slashing the long-range version of the sedan by the same amount. And the Tesla also shaved some $2,000 off the price of the performance version of the Model 3, as well as the performance versions of the Model Y sports utility vehicle. So what do these discounts mean? Two things. It will dampen the company's profit margins, but it will help stoke demand. And we have the CEO, Elon Musk, downplaying the trend so far. He said that, the company could sacrifice earnings up front, but it could make it up by software upgrades. Tesla shares are now dropping by some 2.5%. The stock has more than doubled this year, John. It's up by 111%. Tesla has delivered some 435 vehicles in the last 3 months, but it's still short some 20,000 of what analysts were expecting, John.
What a move on that name this year. Isabel, thank you. 254 in early trading. Let's finish on consumers. Levi's wholesale concerns persist after reporting third-quarter results. The CFO saying this: "Given the ongoing uncertainty in the macro environment, we're taking a cautious approach to our outlook for the fourth quarter." Katie, that stock down 3%.
Yeah, it is a down day for denim. Quarterly revenue came in light, and that led the company to take a, quote, more cautious approach to its projections. Levi now sees EPS at the lower end of its previously stated range while scaling back its revenue outlook as well. Now, if you take a look at the last few quarters, Levi actually either met or beat its estimates, which makes, of course, this latest round of earnings even bleaker. And of course, they're the first major U.S. apparel retailer to report, and their results are closely watched for that reason. Levi's CEO told Bloomberg News in an interview that, quote, "middle-income consumers and below are definitely being impacted, especially here in Europe, but that's also true in parts of Europe as well." Now, the sell side not too impressed. While the direct-to-consumer business was a bright spot, it was the wholesale business that remains a concern in some of the reports coming out this morning. And you can see that in the shares. Levi currently down about 2.7%.
Katie, thank you for the update. Allow me to give you the update for the broader market. If you're just joining us, where have you been? You missed it all in the last hour. The jobs report, a blowout number, 336,000. The estimate, 170K. The previous number, 187. The move you might expect. About 16 or 17 minutes in, or rather 6 or 7 minutes in, equities are down by about 0.5% on the S&P. The Nasdaq's down about 0.5%. Major moves in this bond market. Yields up another 12 basis points to about 484 on a 10-year, on a 2-year, back to 5.1%. On a 30-year, we're back at 5%. We're back now with PGIM's Mike Collins, Crossmark's Victoria Fernandez, Mohammed Al-Arian. Mohammed, I want to come straight to you and ask you about the financials, the banks. Typically, we talk about good data, higher yields, good for financials. That's not happening. Why not?
I think the markets are concerned about two things. One is the impact of higher NIMs potentially higher net interest margins are being offset by deposit outflows out of banks into money market funds. The second issue, which is of more concern to the market, is that there's a worry that if interest rate risk continues to be in play like this, it will translate into credit risk and liquidity risk. And I think that is what's being captured by yet more pressure on the financials.
Victoria, is that something you're worried about?
Yeah, I mean, I mentioned a few minutes ago that we were concerned about the liquidity issues that we're seeing in the market, and I think that's part of what you are seeing in the financials, along with the fact that you're seeing like cities say that charges on credit cards was actually down over the last few weeks. So the consumer is getting hit a little bit harder. That has to be concerns growing then around lending, around delinquencies on credit cards. All of that feeds in to what these financials are doing. And when you tighten those financial conditions and when you squeeze the liquidity that's in the market, financials are not going to do well, even with the re-steepening of the curve. I do think, however, we'll see financials start to come back because their balance sheets are strong. So even with all the macro data that's going on, the balance sheets themselves should be able to hold through the volatility. So I think you want some exposure to them for longer term holdings in your portfolio.
Mike Collins, I want to talk about these unrealized losses in this Treasury market. The price destruction in treasuries, particularly at the long end, since we peaked back in spring 2020, has been absolutely phenomenal. The team here at Bloomberg broke down the numbers earlier in the week, and at the time that story was published, the numbers looked like this. Bonds maturing in 10 years or more, they've dropped 46% since peaking in March 2020. 30-year bonds, even worse, tumbling 53%. These are monster moves, Mike. They're getting even worse this morning. Mike Collins, who owns that? Where's that pain right now? Where's it sitting?
Yeah, Jonathan, that's exactly where I wanted to go. And that's kind of the third leg of Mohammed's stool that could hit not only financials, but broadly the whole economy, right? And who owns those bonds? Fortunately, you know, the Treasury or the Fed owns about 8 trillion of them, right? So that actually does cushion the blow to the private sector. But insurance companies own them, pension plans own them, individuals own them. And it's not just bonds being marked down, Jonathan. It's all asset prices. I just came from a real estate conference, and people are really worried about the potential for a lot of forced selling. A lot of people bought real estate at high prices over the last couple of years, and those marks are moving down, and they still have a long way to go down from where they are today. And the financing cost, if you didn't lock in your rate, is going in the opposite direction. So a lot of these are now underwater, right? So it's really across the whole economy. You see it in stock prices every day, but it's really the slow-moving prices. It's the private debt. It's the commercial real estate. That's another shoe that hasn't dropped yet.
So, Mike, I want to push you a little bit more on this, if I may. Because it's not just domestic, it's global. People are also worried about the spillback from the Japanese reaction. So is this a slow-moving process that the market can accommodate and the economy can accommodate? Or is this something we should be worrying about tipping points?
You know, I think it is a slow-moving process. Our base case, Mohammed, is that there isn't as much leverage in the system generally. Like a lot of this real estate hasn't been overbuilt. It hasn't been over, levered. Certainly the housing market is not levered at all. The banking system, as Victoria pointed out, is not a levered system anymore, right? So that's really good. But as the realization of these lower asset prices, and you do get liquidity events and flows where people have to, realize those losses at some point. And so maybe it takes quarters or even years to get realized, not days and weeks, but that is something that does nag at us over the intermediate term and make us certainly more cautious on the global credit markets in general.
Mike, we've heard a lot of Wall Street phrases, cliches through the week, catching falling knives, buyer strikes, all of that bad stuff. Mike, your colleague, Dalip Singh, talked about the loss of predictable demand in the Treasury market, China, the Federal Reserve. Mike, that's not coming back potentially. How does that change things? That change of character in the sources of demand, what does that mean for this Treasury market, this Treasury curve?
Yeah, I mean, part of that, believe it or not, Jonathan, again, this is kind of wonky stuff. Some of that is priced in. If you look at long-term Treasury yields versus long-term expectations of the funds rate or other derivatives on that interest rate, it's about a 70 basis point yield premium that the Treasury is actually paying every time they go to the auction block to issue Treasury. So there is a supply premium already built in. You could call it a credit premium in some cases on the Treasury market, built in already, and that's one of the reasons that yields are at these higher levels. And whether that persists or not is anybody's guess. But it's a little encouraging that a lot of that is priced in.
Mike Collins, thank you. Mike Collins alongside Victoria Fernandez, together with Mohamed Al-Erin. I'm pleased to say Mohamed's going to stick with us. Stocks pulling back by about 0.6% on the S&P 500. Up next, the September payrolls report coming in hot.
This is a much stronger labor market. Clearly, that's what we see in the report today across the board.
Acting Labor Secretary Julie Su, up next.
The boundaries of the entertainment world are blurring, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
I know one of the reasons you're here in Marrakesh and in Africa, because you see the enormous potential this continent has as a source of renewable power for electrolysis, right? That's the process by which hydrogen is extracted from water. Tell us about Africa's potential.
Africa's potential is the best in the world, and it's Africa's shot now. It's Africa's turn. What will stop Africa rightfully taking its turn will be lack of progress on technology. Companies and governments around the world choose Fortescue because we are the world leaders in technology, world leaders in next era electrolyzer design, cables, solar, all the tech which is moving our world on from having to rely on dinosaur era fossil deposits of oil, coal and gas to simply today's era of machines which make machines to harness all that beautiful renewable energy and give all the mobile energy, all the fixed energy this world could ever need by many times. Those countries who resist that are denying Africa their opportunity. And I'm saying, stop it. Let's get in behind Africa.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Live from New York City on Bloomberg TV and on Bloomberg Radio, I'm Jonathan Ferro. Joining us now from Washington is Julie Su, the acting U.S. Secretary of Labor. Julie Su, wonderful to catch up with you. A hot labor market report at a time where the unions seem to have a lot of leverage, so let's go straight there. What's your latest read on the UAW negotiations?
Well, the parties are at the table. They're continuing to negotiate. The president has made very clear, something I believe in too, that when there are record corporate profits, there should be record contracts for working people, and that's what workers are fighting for. So the negotiations continue, and I believe that the parties will get there.
Are you getting access to both parties to help negotiate a settlement?
Yeah, we're talking to both parties. I mean, again, the collective bargaining process is about the parties themselves coming together, working through their issues, finding common ground and win-win solutions. We support that in every way that we can, and we are continuing to talk to the parties in that particular situation.
What have you heard recently about current demands from UAW? We understand that wage demands have come down from 40 closer to 30. Is that your read on things?
I mean, and negotiation is always about movement on both sides. At this point, you know, I think it's always hard to know exactly where something will land. I think as long as they're talking to each other, that is positive, and that is what is happening.
You're sensing the gap is closing, the spread has narrowed.
I'll say it this way, you know, I've seen this a lot. I think that the parties always seem like they're far apart until they're not. So that does require, it always requires movement. And I think the continued engagement is a positive thing. And it's part of the reflection of President Biden and this administration's commitment to workers getting their fair share in an economy that is doing really well.
We also have healthcare strikes as well. I understand you've met leadership from both sides. Julie, how different is that particular strike? What do you think is going on there?
I mean, every strike has its unique issues, right? Every, you know, the industries are different, the specific demands are different, but I think at the bottom line is that we are seeing a resurgence in worker power, in support for unions in the economy, and for working people demanding their fair share, saying, you know, enough of the disparities between what frontline workers make and what CEOs make, making sure that there is an opportunity for workers to improve their working conditions and live stable lives this is not just an accident in a Biden-Harris administration. It is very much a deliberate part of how we think a strong economy and a strong country works.
Madam Secretary, as you rightly said, we are seeing a shift back in bargaining power towards labor after decades where it went the other way. That's being reflected in a spike higher in number of days of strikes throughout the economy. Should we expect that number to go even higher?
I think it also reflects really record contract results, right? So we've seen from the ports on the West Coast to the Teamsters and UPS, really results that demonstrate workers getting more in wages, ending forced overtime, dealing with other specific issues within certain industries, around automation and the like, addressing conditions like heat and other kinds of health and safety issues. So I think those are the big results. And some of them we're talking about, you know, we don't talk about them as much, but there are, you know, graduate workers who have gone on strike for brief periods and gotten contracts that they want. So I don't know what the average number of days is, but I do know that workers coming to the table, being able to have the right to demand their fair share is something that has been positive for workers and is very much part of the strong economy that we've been talking about, and the jobs report reflects this.
And yet we have not seen that in the numbers on earnings. So is it just a lag effect? Are we going to see it going forward? Or is there something else going on in the economy that's offsetting those gains that you talked about for workers?
Yeah, so earnings are up a bit. You know, we definitely especially see that among lower wage workers, which is part of this idea that, you know, the president has said, we're going to build an economy that leaves no one behind. That starts by looking at who's been left behind in the past. And to the extent that those lower wage workers are seeing average gains that are growing and also that are higher than inflation, means that workers have more money in their pockets, more to spend in their local economies. That's also partly fueling the other effects of the jobs report, which is, you know, more job growth in leisure and hospitality, for example. All of these taken together, along with the historically low unemployment rate, still under 4% for over a year and a half, the longest stretch of the 1960s, are all signs that this economy is a place that, you know, is doing well because of good economic policies and workers having a seat at the table.
Well, let's talk about those policies. There is something really peculiar going on at the moment. If you think about what's happening at the picket line, they have serious concerns about the EV transition and their participation in it. A transition that you are subsidizing. Something really odd from my perspective, and I'd love some clarity from you on it. Why is the government offering rich people credits to buy expensive cars?
So a couple of things. There is widespread support in the country for tax credits that will help to bring manufacturing jobs to the United States. That's part of what we're trying to do. The other is that we do have a climate crisis, right? We saw record heat across the entire country, across
without
the
a doubt.
globe,
Can I
really.
just jump in? Without a doubt. I totally agree with you, but I just think we're conflating solving a climate crisis with driving really heavy SUVs that run on electricity. Are those two things part of the same story? Because I don't get it. If I'm driving an electrified F-150, am I really saving the planet?
Right. Well, so we could probably have a conversation now about personal choices relating to cars. I do think as a policy matter, the more that we can invest in industries, in manufacturing, including in transportation, that transitions us to a place where we're not, we're not continue to pollute the planet, right? We have a method by which we can both bring down emissions and also create good jobs. And the president has always said that solving our climate crisis, when he looks at that, it's also about creating good jobs and good union jobs in communities that need them the most. And we are really focused on making sure that that transition does not leave workers behind, and that what's good for the climate can be good for workers as well.
Julie, appreciate the update. Julie Su, Acting US Secretary of Labour. Equities down, your trading diary up next.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Mohammed El-Arian, you get a final word this morning. What a morning so far.
It is a morning, John, and it's one that should remind us, whether it's the job reports, the UAW, that it is about the supply side. We should get used to the fact that the supply side is a constraint, and that means difficult decisions across the board. And unless we make these difficult decisions quickly, including at the Fed, we may mishandle this last mile in the fight against inflation.
Mohammed, thank you, sir. Fantastic to catch up this morning. Live from New York, this is Bloomberg.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the US and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, good Friday morning from the Bloomberg Interactive Brokers studio in New York City. To our worldwide audience, Matt Miller and Paul Sweeney joining you here. Boy, what a blowout payroll number here. Just kind of double the economics we're looking for. So we'll break all that down coming forward throughout the next few hours. Plus, we're going to check in with Dan Ives. He's the senior equity analyst at Wedbush Securities. We're going to talk tech, Apple, Tesla, all that good stuff.
As rates get higher and higher and higher. I mean, they've done well so far with these higher rates, but at some point, it's going to be difficult.
Yep, absolutely. So, all right, we're going to talk with him. We'll talk all kinds of fun tech stocks there. But right now, let's go to John Tucker and get a Bloomberg Business Flash. We'll kick this thing off.
All right, also red on the screen, but pairing some of the earlier losses, is today's bang-up jobs report going to result in another rate hike from the Fed, or does it indicate a resilient economy that can end in a soft landing? Well, one of the takeaways, the wage component that shows may not be as inflationary as feared, this jobs report. Stocks again lower, but do pair some of the earlier losses. Yields still elevated, in fact, surging to multi-year highs. Former Fed Governor Randy Kroszner, he reacted to today's jobs report a little earlier.
The silver lining is that we didn't see a lot of kick up in wages, because that's really ultimately what is going to affect costs and what's going to drive inflation. Maybe I was being too harsh in saying there'd be a hardish landing. Maybe we've got something that's perfect Goldilocks. I find it hard to believe. It's possible.
Right now, the S&P 500, 32 points lower. That's down 0.75%. 42.27 on the index. The Dow Jones Industrial Average down 183 points. The NASDAQ 100, 110 points lower. That's down 0.75%. 2-year yield, 5.09%. That's up 7 basis points. The 10-year, 482. That's up 10 basis points. The 30-year, the bond, the long bond, right under 5%, 499. That is up 10 basis points. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker studio. We're streaming live as well on YouTube, so head over to youtube.com and you can search Bloomberg Radio there and get you everything you need to go. Let's figure out what's going on with these markets here. Big moves in the equity markets, big move in the bond markets as well. We'll check in with Bloomberg Equities reporter Nora Melinda. She joins us live here in our Bloomberg Interactive Broker studio. Nora, what are you looking at?
The story of the day today is obviously jobs data. We did see stocks, all three major indices, really plunging this morning. They paired a little bit.
Excuse me, I'm going to stop you right there. Just because I'm a very old Bloomberg employee.
Yeah.
And, you know, you're a fairly young new hire. Indexes is Bloomberg style.
Right, you're right.
I already got this, Nora. And
Is it okay for me to have my preference? I love indices, but we will go with indexes.
Grammar police, style police,
Just the Bloomberg way,
fashion
page
police.
132, you'll see indexes.
I've already been
I need to
corrected,
reread the book.
Or on the terminal, STYL go.
Yeah, okay.
Yes, that's where you can find it. But all three major indexes are lower this morning. But I'm looking at a few names, specifically Tesla. It's down in trading this morning after cutting its prices on one of its top-selling models in the U.S. Of course, this is a continued push to stoke demand. You know, Musk has really been adamant about bringing down prices. Hopefully that will spur demand. But I know, Matt, you're a car guy, right?
Well, let me frame it this way, Nora. I mean, this kind of goes to a bigger question for me. There's a million ways to slice, and we'll talk to Dan Ives a little bit about this. But what do you think the real underlying long-term demand for EVs?
Well, that's a great question. And, you know, I was asking myself that this morning as well. I got an email from Hertz. And remember, they did this big deal with Tesla and bought, I don't know, 100,000 cars, right? Now Hertz sends me an email because I'm a gold member.
Of course you are.
No big deal. You know, I've been around. People know me. So it says, if you rent an electric car, they'll give you 1 free day.
Really?
For now. And they'll give you 1 free day for later.
Oh,
so, like, first I thought, awesome, I can save money. But then I thought, maybe there's not a lot of demand for EVs. Because I was just at a Hertz last week in the great state of Ohio, and I was looking to get either the Mustang or a convertible Camaro, and they were like, we have Teslas, and I said, no thanks, you know? So I wonder about the demand as well. We'll talk to Kevin Tynan. He's going to join us a little bit later on from Bloomberg Intelligence. He is our chief autos analyst.
Yep. Right.
And we'll ask him that demand question as well, because I don't know. It seems like the underlying demand is not as strong as Tesla and Hertz would like it to be.
Right, and of course, but Tesla valuations still remain really high, and as it's pushing into AI, I know that's been Musk's main focus, but when it comes to Tesla in the car space, we're really seeing him struggling to get demand higher. But also looking at Clorox, that's ticker CLX. Yesterday, that stock fell as much as 7.6% throughout the session to its lowest intraday since June of 2022 last year. It's paired in trading today. It's down about a little bit under 1%, but essentially, it's reeling back from a cyber attack that disrupted production. And prior to the attack, it's disclosed in mid-August that it had been expecting mid-single digits of organic sales growth in the quarter. So analysts are really bracing for further fallout, but Clorox did caution that it expects to experience ongoing but lessening operational impacts into the fiscal second quarter.
All right, Clorox, when I think of Clorox, I think this is a great old American company, been around forever.
Old economy.
Went public in 1983. Goldman Sachs was the lead manager at a split adjusted price of $2.86. 1983 went public. Pretty cool. Anyway, go ahead.
Yes. And lastly, looking at Levi, you know, that's a denim brand. That's an oldie, right?
Yeah.
But it's coming back. It's coming
in Paul's
back.
opinion, this Levi's are no jeans.
And as we go today.
Right? Oh, we're sporting them today.
Right.
Good.
By the way, Levi's business model is the same for Bloomberg LP.
Okay.
That is, don't go into the fields looking for gold and mining, sell the supplies to the miners.
There you go. That's it.
I love
That's
it.
It's
I love
as
it.
simple as that.
But that denim brand, it's down its lowest intraday level in more than 3 years. It tempered its revenue and profit expectations for the fiscal year, and it's really seeing a hit, plunging as much as 6% this morning. Analysts are continuing to have concerns around its wholesale business, but they are impressed with its direct-to-consumer results.
Ooh, 52-week low today. Market cap of $5 billion. All right, I'm doing my part.
When did Levi's go public?
Doing your part.
I don't. They either. It says here 2019, but I think they went private or they had some financial difficulties. But they came out of it with some private equity ownership. I'm not
But
sure
founded in?
Don't know.
1853.
There we go.
And what do they
Way back.
do? What do they do with the remnants of blue jeans? Anybody?
What? Like you mean the little pieces of fabric left over after
Please
cutting?
let me know.
What do they do with that?
Make it into a blanket?
Make it into United States currency. That is a key component
way.
for making the greenback.
I
He
did
spends
not
all
know
the
that.
time looking at these crazy YouTube videos, and this is what he comes up with.
Come on.
The more you know.
That's the only thing anybody's going to
very much.
remember.
Now, Nora, we see, I just want to point out, in terms of movers, Pioneer also is a big one today. And obviously the Exxon reporting surrounding the potential takeover, a potential $60 billion takeover, pushing those shares up. But they're up right now more than 9%, almost $20 a share to $234.49. So this is...
We're going to have Alex Steele on at noon from Bloomberg Television. That's her beat. She's all over the energy space, so we'll get her.
Ticker is PXD. Just to be clear, PXD.
There you go. Very good, Pioneer. I don't know who the advisors are, the bankers on that. I will report that as soon as that happens, because to me, that's the important stuff. All right, Nora, thanks so much for joining us. Nora Melinda, she covers all the equities for Bloomberg News. All right, the big move, I mean, you get this print here in the payrolls, Matt, and bond market, boom, immediately moves higher. We've got yields out there.
It was exciting when it came out at 8:30. I looked immediately. I got this screen here with all different assets, from fixed income to currencies to equities, and I just saw spikes in the 10-year yield, spikes in the dollar, a spike down in S&P futures because the market wasn't open yet. So a lot of action on that number.
Yeah, so some of these yields are the highest since 2007, the summer of 2007. So let's break it down. We bring in Kevin Muir. He joins us here to kind of give us a sense here of what's happening.
Oh, nice.
You know that. Why don't you bring Kevin, see what he's got?
All right, so
for us.
I'm excited to get the macro tourist on the air because I read, I get Kevin's newsletter and I read
the macro tourist. Cool.
Read that, and a couple days ago I was really struck by his take on whether or not you buy bonds here, because every time I see these rates ratchet higher, I'm like, man, he back up the truck because there's no way you can lose. Like I thought, 20-year bonds at 4.5%. I got to buy those things. But I learned from reading Kevin's stuff, and I have learned over the years that the further you go out in duration, the more sensitive price is to rates. So if they tick up just a couple basis points, you're losing a lot of money. Kevin, talk to us about this really historic moment today, the 30-year yield over 5%.
Yeah, I picked a great day to be here. Lots of excitement. In terms of the yield curve, and you're absolutely right, Matt, when you mentioned that everyone's out there buying the TLT, you see the expansion of the number of ETFs created. Everyone's saying, I got to go out, I got to get long bonds because this is a kind of once-in-a-lifetime opportunity to buy them. And my point was, yeah, sure, for trade, it might work, meaning that if the economy rolls over or we get a market crash, you might make money on that long-end trade. But if you think about it from a longer-term perspective, and you accept that we've changed the environments that we're in, and we're not going back to that kind of post-GFC, pre-COVID 0% rates, and we're going to be in an environment with higher rates for longer, what you realize is that even if the Fed goes and, let's say, reduces rates by 200-300 basis points, let's say they take the kind of Fed funds from 5 down to 2 or 3, and if you look at what happens as they ease, the yield curve steepens. And if you go look at the 230 over time, during recessions, that can steepen out to kind of 400 basis points. So we could have a situation where you might get the call right on the economy, or you might get the call right on the market crash, and you think I should buy bonds. And what happens is the Fed comes, reacts to it, and the long end, instead of going down in yield, actually rises in yield because the market gets nervous about kind of the ensuing inflation that might come from their easing.
Well, and yesterday we were talking about if you had bought the 30-year in the heart of the pandemic in 2020, it's now worth 46 cents on the dollar. And
Yeah.
I don't know if anybody, well, certainly retail investors don't think about the fact that you could lose that much of your capital on treasuries, right? And I get that it's long duration, but hey, you bring up another interesting point in TLT, which is I think it's 20 years plus, right? ETF, treasuries ETF. So
Right.
20 years and longer duration. We've just seen incredible inflows there, and I saw a piece in the Bloomberg story on Michael Hartnett today pointing out that Treasury funds took in $4.6 billion last week, and that's their 34th straight week of inflows. How is it possible for these funds, and I guess they're mostly ETFs, I'm not sure, to take in so much money, so many people buy them, and yet the price of the underlying asset goes down, 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 down?
Well, the government bond market is huge. Well, so when you think about the amount that the TLT's done, it's just a drop in the bucket. That's a tiny little market, and they're a minute player in terms of what has happened. And the dynamics in terms of the kind of market expectations about what's occurring in terms of the higher for longer is just kind of overwhelming things right now, Matt. So it just, in essence, for the longest time, everyone thought that there was going to be a recession. If you go and you look back at like the Bank of America surveys at the beginning of the year, they were convinced that there was going to be all sorts of, an imminent recession because of the higher rates. And what you're seeing now is that the big kind of fund managers, the ones that were making those bets, are finally giving up on it. They've accepted the higher for longer from the Federal Reserve. And it was the dot plots that did it, in essence. I'm actually shocked that was the kind of the trigger, the catalyst for it. But was when those dot plots came out, they came to the realization, hey, the Fed's not going to cut like we thought. The economy is going to be stronger than we think. Therefore, we priced the long end all wrong.
Hey, Kevin, one of the many things I like about your website, The Macro Tourist, is right up front, you tell people, all I bring to the party is 25 years of mistakes. And boy, I can relate to that. So do I just go stick my, vast, resources into the 2-year treasury at 5.09% and just sit there and clip coupons?
Well, that is a great trade in terms of if you're talking about cash. And I think you need to kind of differentiate between people that are trading in terms of investing just on a cash basis versus those that are speculating. And one of the things that, Alec Gurevich has this line that he says that easing is steepening. And I think that's a great line. And that goes back to my point about the fact that even if we get the Federal Reserve lowering rates, you might not actually find yourself at the long end doing that great. Now, if you just paid cash, it's no big deal. And one of the things that I think a lot of people are missing in terms of when they start thinking about shorting these bonds, when you were shorting a 10-year at 2%, when it went from 2 to 2.5 in terms of yield, you only earned 2% in the meantime, in terms of to pay back the duration loss, let's say, from the capital gain, the going down. Now at 5%, these things carry a lot more positively in terms of if you're just owning it outright. However, if you're buying it on margin, meaning if you're financing it, you're still financing it at 5.4% or whatever the overnight repo is. And after today's announcement, it looks like the Fed's going to go and most likely going to raise rates again. And so the levered buyers are the ones that are really hurting. And that's really what we need to see. We need to see the long end move to a point where they can finance it and hold these things without losing money. And until we get there, I think that there's going to be some continued pain. So on the one hand, if you're just buying it for cash, nothing wrong with going and owning the 2-year. But if you're speculating, I think that you really need to wait for the fact is until these carry positively, it's going to be tough slugging.
Kevin, you only got a minute left, but you've mentioned Tua a couple of times in your newsletter. And I wonder if you can just explain to us, this is an ETF, right? The Simplify Short-Term Treasury Future Strategy ETF.
Harley Bassman's.
What do you think about it right now as an investment? Well, what is it? Explain just briefly what it is and what you think about it as an investment.
Instead of owning a 10-year or 7 to 10-year, it tries to mimic the same duration by owning 2-year futures. And it's on a levered basis. And this is the trade that